morning. It's the end of the week, end of a truncated week. You're watching India Market Open, where Niraj and me will take you through all the action. Fortunately, this morning there's some Friday cheer for global markets. Now, whether it trickles down to India is anybody's guess for now.
Sorry, who won the bet?
I think I did. It was flat as a pancake. It was
green and starting off well today.
That's today. That's today. But yes, Friday, I think Wednesday was a tough day. We were volatile, tight range, didn't really leave much for bulls or bears to take home.
Yeah.
But of course, gap up this morning. But Niraj, I am sensing that our rally is looking slightly more tired than the rest of the world, right? It looks like it's lofty on the top.
Yeah, it is. But somehow, Samina, like we were talking about 7-8 days back, right? The closer we get to the Fed action, I think there's optimism, because last 4 years since COVID lows, what has driven the markets the most has not been earnings, not been anything else. It's the Fed. And if the Fed is going to cut rates, it'll be risky to be short any equity market currently. So prudent to be.
Also, knowing how our markets are or how world markets are, it's usually buy the rumor, sell the news. The closer we get to the event,
but we haven't bought it as yet. So I'm saying let's buy the rumor.
Look forward to. Okay, we will look forward to the rumor for now, and it's not really a rumor anymore. The Fed, more than a given, is looking to cut rates. 65% of Fed futures are indicating that the Fed will move with a rate cut pretty soon. Well, that's how the world looked in overnight trade. It was a solid run-up on Wall Street. The US markets gained how in trade, to say the least. You also had economic data point that indicated that the US is not rushing into any form of recession. So anything that was making the bulls slightly nervous last week is now far behind us. The Dow, the Nasdaq and the S&P 500 eked out very strong gains. The broader markets are up almost 8% from the August 5th lows. Now, that's what you want to take note of, because clearly indicating that what we saw 2 Mondays ago is no more stands, or no more is a reality for Wall Street traders. Tesla, Walmart, Target were amongst the top gainers in overnight trade. What drove the markets in overnight trade is the fact that economic data has come in better than what the street was expecting. Retail sales were up 1% versus an expectation of 0.3, indicating that Americans are going out and spending money. Usually not a sign when the economy is in a recession. Also, the other good news is that weekly jobless claims has also declined, meaning that there are lesser people filing for unemployment benefits in the US. So a better than expected economic setup is what drove traders on the street. Well, talking about rate cuts that Niraj and me were discussing, like I said, the markets are now pricing in a 75% chance of a 25 basis point rate cut in September, and a 25% chance of a 50% rate cut in September. So it's not whether the rate cut is going to happen or when it's going to happen. The only thing that people probably are debating now is the quantum of the rate cut. The yield on the 10-year and the 10-year and the 2-year Treasury rose. The dollar also strengthened against the euro. So that's what happened on Wall Street. A pretty good-looking handover from the US markets. Across Asia this morning, those markets are very closely tracking Wall Street. They did the same on Wednesday as well, so no surprises there. Across Asia, all those markets are deeply in positive territory. Look at Japan. It's up 3% as we see it. China is participating for a change. So is Hong Kong. South Korea also not too far behind. Well, Asian traders are eyeing a bunch of economic data coming in from those quarters. So you've got Taiwan and Hong Kong that will report on their second quarter GDP data. But remember, this will come in after market hours. So the Asian markets will only respond to that in Monday's trade. The yen is at 149.13. The reason I mention this is because it's eased off its 7-month high that was seen on the 5th of August at about 141. So clearly indicating that the worries around this Japanese carry trade unwinding may just be behind Japanese markets or Japanese traders for now. So that's what the world looks like. Implied Nifty, more than certain, is indicating to a very solid start this morning, 174 points. Niraj, we're going into the weekend with a pretty big bang, and we've got so much to catch up on from Wednesday's gains that we didn't see.
Yeah, exactly, because Asia 2 days on a trot now, Samina, doing so well. So which is why I think, as Samina laid out, the implied open looking so strong. Now, for the last few days, we've been talking about how quant indicators are implying that there is an upside around. I'm glad finally it is coming up on the screen. Though, if you look at the internals, and here's the trade setup, if you look at the internals, at least my version, there are conflicting signals, because if you look at what the quantum of stocks in the F&O ban or VIX, which came off on Wednesday session, but still at about 15, might indicate that, oh, is there a possibility for downside? But like I've been saying for 3 days now, various quant indicators are indicating that there's a very high probability of an upside. We'll see the starting signs of that. Will we build on from there or no is the question. And one thing that stands out is that if you look at the options concentration on the call side, 24,150 and 24,200, very, very high activity, very, very high concentration. And if indeed the markets stay stubbornly higher at those levels, then you might well see some unwinding there, and that might actually help the indices go up higher, right? Because if there are call options written, and if indeed the markets stay higher, then those options become worthless, and therefore they have to unwind. And if they unwind, they put an upward pressure on the index. I hope I'm clear. So that's the first part of the Nifty per se. And then the Bank Nifty follows suit, of course. So keep an eye out for that. And then when you look at sectors, I think four-wheelers might have a bit of an issue. And today I won't talk too much about it because my colleague Tushar on Editor's Cut is going to speak about the higher inventory levels in the four-wheeler end, and which is why there might be an issue or two for the four-wheeler stocks in particular, even if not two-wheelers. By the way, Hero MotoCorp 2 corrected, but four-wheelers in particular. So that's one thing to watch out for. And, you know, viewers, we've been telling you about how we've been the exclusive media partners for the MK Confluence or the MK Investor Conference, a 3-day event, 210 corporates, a lot of meetings. I think from what they've told us, the one key thing or the one key sector which stands out at the end of 3 days is industrials. The space is looking good according to them. Managements are talking about some significant growth, extended growth period ahead. And the MK email says that even conservative managements who hitherto have never invested are invested in capacity expansion. So I think that's a bucket you want to watch out for. Samina, you know, ABB was speaking the same thing, that while the high growth sectors and the new age sectors came in and invested in capex, they are now seeing the turn of the sectors which hitherto had not participated, metals, to an extent cement, etc. And therefore, that is the set of sectors which will come in and help move the capex back on higher.
The next leg of rally for some of these industrial names.
Capex and industrial. So
just to add to some of your data points, even the PCR, which usually higher it is, indicates that the bulls are in control of the street. So on Wednesday, what we noticed is the put-call ratio also went from 0.78 to 1.14, indicating that the bulls may be in control of the street. The trading range, Niraj has already highlighted, but in my opinion, 24,300, 24,400 becomes an important level of resistance. If that does get taken out, we could be heading all the way back to levels of 25,000. Niraj, just one quick thing that I wanted to come to you on. So you have the WIX that's cooled off, PCR that's improved, very strong global cues, earnings that aren't looking too bad, metals hopefully rebound and IT rebounds on back of global cues. But I went through a bunch of short-term trader calls on the market for the near term. Everyone, so 4 out of 5, had a sell on rally at 24,300.
It'll be interesting to see if that happens
if that
today,
plays out. And also, let's not forget that you made a record high on 1st of August of levels of 25,000. You're 4% off record highs on the Nifty. But all in all, I think we've summed up what trade is going to look like. You also want to watch out for Bank Nifty. 49,700 on closing basis is a very important level to watch out for. So keep a close eye out at 49,700. A very good chance we should see an upside on that unless PNB and SPI spoil the party for Bank Nifty. But Bank Nifty looks good. The benchmark looks good. We've got a whole bunch of positive cues. Nothing really negative this morning, apart from the fact that it's the weekend and you might have traders who may not want to go in with very heavy positional trades. But let's move on to earnings, because I've got a bunch of really solid earnings that I'd like to report on. Topping my list is Glenmark Pharma. I mean, solid performance coming in from Glenmark Pharma. Revenues were up nearly 7%. EBITDA has come in 35% higher at 588 crores. It's slightly below what the Bloomberg estimate was, but year on year, the number looks pretty strong. Margins have also improved pretty significantly, 371 basis points to come in at 18.13 versus 14.41. Net profit has seen a big jump on back of operational efficiency. So profits are up ninefold to come in at 340 crores versus 173 crores. Remember, the broader market sentiment is positive, so I think traders and investors will want to focus on the PAT number in today's day of trade for Glenmark Pharma. Well, let's take you through what led to higher profits for Glenmark Pharma. Large decline in finance cost and input cost. Finance cost came in at 39.6 crores versus 111 crores that was seen in the same quarter last year. And they also, in the same quarter last year, an exceptional loss of about 52 crores, which is not there anymore. So on back of that, Glenmark Pharma on the face of it looks pretty fantastic, largely in line with Bloomberg estimates as well. Well, the other one is Equinox. Strong numbers, and hence I'm highlighting this. Revenue came in at 98% higher, coming in at 387 crores. EBITDA loss was about 31 crores, but remember they also had a loss in the same quarter last year of 58 crores. Net loss of, EBITDA loss, net loss of 28 crores versus a loss of 679 crores. Now, I'd love to know what's happening at Equinox in more detail because those numbers look a little interesting to say the least, but Equinox could be one company you want to track in the broader market space. You also have SpiceJet that's reported numbers. Profits have fallen 20%, revenues have declined 15%. Other income has seen a significant jump at 369 crores versus 263. There's been a reduction in finance costs, and the board has approved 3,000 crores of fundraising through a QIP. Don't know if our viewers remember, but when Indigo had posted numbers, those numbers were actually very good as well. So as compared to Indigo, SpiceJet numbers don't look as good, largely because while the finance cost has come off, their margins haven't improved significantly on back of lots of other moving parts. So all in all, I think good numbers from Equinox. I'd say Glenmark as well stands out. And SpiceJet, while looks okay on the face of it, if compared to Indigo, I think Indigo was a better performance.
Oh, most certainly. I mean, Glenmark looking very strong, and in SpiceJet, I mean, sometimes I just apply this rule, right? That are you using the product of the stock?
We all prefer Indigo versus SpiceJet.
Indigo, Vistara, what have you. I don't remember the last time I flew SpiceJet because there have been so many cancellations. So no surprise that SpiceJet is having issues.
But they have a pretty big jump in other income. It'd be interesting to know what that comes in with, right?
Yeah, and I also hope, Samina, that the airline revives. It's great for customers to have options, but
also, Niraj, you know what's interesting? Some of these earnings, most of them in the broader market space have managed to bring their finance costs down significantly.
Yeah.
Now, that I think is something you want to watch out for because this really implies that operationally some of these companies are doing well. And if Niraj mentioned how companies in the industrial space are going to do better on the revenue front, then you have a pretty sweet cocktail, right? Operationally better performance, your margins are good, and you're even selling more. So all in all, it's a cocktail for a bull to go out and buy.
And last 4 years, Samina, I mean, the in corporate India balance sheet, as most people have said, has never been better. So in some sense, great. Okay, but specific stocks before we get to editor's cut. So Capacite Infra is the first one on my list. Revenues up 32% at 570 crores versus 430 crores. EBITDA margin at 18.94% versus 16.39%. So up 255 basis points. Effectively from 16.39 add to 55 points goes to 18.94. So very strong performance on the EBITDA margin front. Net profit, therefore, up 179% at 53 crores versus 19.08 crores. Very strong performance by Capacite. You couldn't find a fault with this one. You know, maybe with KNR you could, not with Capacite for sure. So good numbers. Watch out for this one. Pitti Engineering. Revenues up 32% at 383 crores versus 290 crores. EBITDA margins were flat, but the net profit up 50% as a result. 21 crores versus 14 crores. I mean, there are other companies like Capacite which are 179% jump, but doesn't mean Pitti at 50% is to scoff at. Very strong numbers. Last 1 month has done okay. Watch out for Pitti, could do well. And Entero Healthcare is the third one on my list. Very strong numbers again. Revenues up 22% at 1097 crores. The estimates were 1066. So that's in line. EBITDA margin 2 in line. Net profit above estimates. 20.5 crores versus 6.4 crores. The estimates were 13 crores. Now, the beauty about Entero, viewers, everything else notwithstanding, is one, they've made some acquisitions, and the acquisitions are margin accretive because the acquisitions have a blended EBITDA margin of 6 to 8%. So from a current 3%, for the acquisitive numbers to contribute to 6 to 8% means And I think they've said that they would probably earn 1,000 crores from acquisitions. So therefore, the margins are likely to move up higher. That's part one. And part two, they have said, Samina, that they will achieve 35 to 40% revenue growth for FY25 with EBITDA margin expansion. They've clocked in 22% revenue growth, which means that the next 3 quarters will be substantially higher revenue growth with better margins. Won't be surprised if Entero, on the back of that guidance and the back of the numbers, sees an uptick today. So that's a thumbs up from my end. Entero actually could do well.
Yeah, we also have Ola Electric, but we'll talk about that in a minute because that's, again, a big one and it's got lots and lots of viewer interest. Stock, remember, is up 58% since listing, market cap at 51,000, but I'll let Niraj take you through those earnings. Just before I go into a few more, you've got Sunteck Realty. I think those numbers also stood out. Revenues came in at 316 crores. EBITDA was at a 31 crore profit versus an EBITDA loss of 7 crores. So very strong performance being put out by Sunteck Realty. Margins also looking healthy, around 10%, and net profit at 23 crores versus a loss of 7 crores. So Sunteck Realty, again, solid earnings. The stock will get a pretty warm welcome in early minutes of trade. Max India, disappointing numbers. Losses have doubled now in this case, up to 27 crores versus a loss of 12 crores that we saw in the same quarter last year. And revenues have also declined substantially, down 35% in this quarter versus the same quarter last year. So Max India, disappointing, but apart from that, you've got good earnings. Hindustan Zinc as well, but I think you want to finish up with Ola before we go into Hindustan Zinc.
Yeah, so we'll make this quick, but Ola Electric was interesting to say the least. Revenues were up 32% essentially at 1644 crores, and the EBITDA loss narrowed a little bit, so 205 crores versus 218 crores. Now, multiple levers there and too difficult to try and pencil in. I don't know if Samina has thoughts, but I think one, that they've done well on the revenue front, which is what is expected of a growth company, which is still making losses. And you know, Samina, HSBC kind of gives out that view that they are saying that despite our conservative view on EV penetration in India, along with other uncertainties, we believe Ola is worth investing in because of the sustained regulatory support, Ola's ability to reduce costs, and a positive risk reward in the battery venture. So their target price is 140 with some key downside risks being there. But clearly, suffice to say that the revenue growth number kind of takes the cake amongst everything else.
Indeed, and it's, I mean, just like HSBC, I think retailers have also fallen in love with Ola Electric. Before it listed, there were arguments that it looked like an expensive stock, but if anybody's to go by that, the stock is 70% more expensive today than it was less than a week ago. And of course, a significant market cap. So I think this one has a consumer touch and hence the amount of interest that we've seen. Earnings, Niraj mentioned, they've also had a new launch. We'll take you through all that and more in a minute. But I want to quickly add Hindustan Zinc as well. This is, of course, not earnings related, but Vedanta is looking to offload 3.1% stake in Hindustan Zinc to an OFS between today and the 19th of August. The OFS has a base size of 1.22%, with an option to sell an additional 1.95% stake in the case of an oversubscription. The floor price has been set at 486 rupees. So I don't know whether there's going to be an oversubscription in Hindustan Zinc, but if it is, then 1.95% additional stake is potentially what Vedanta may be looking to sell in Hindustan Zinc. So watch out for this one. I think it'll be interesting to see how the stock moves in the first few minutes of trade.
Yep. And lastly, last couple of things, some stocks in news. Technocraft Industries has announced a buyback of up to 2.88 lakh shares at 4,500 a share. Remember, the stock was up 10% day before on good numbers as well. Now this buyback might be a small buyback, but the price is interesting. So maybe some further upsides there. Brokerage notes, we'll talk about some of them. But the last set of stocks on my list, and which I think Alex and Vishy will discuss in detail, are SBI and PNB. The Karnataka state government has ordered all departments to close their accounts with SBI and PNB, citing alleged financial irregularities. Viewers, it's not just about the extent of deposit loss that may come. I'm sure at some point of time this will get challenged. Maybe Vishy will throw some more light there, because in some sense, events like these make you wonder about a few things. But and the extent of the numbers, like I said, is one thing, but just the sentiment that this puts some of these stocks through could be interesting. And maybe a stock like Canara Bank or some of the South Indian banks might be in for some upsides as well as a result of this. But Alex, it's time for editor's cut. And I wonder what you and Vishy have to tell us, because this, to my mind, was amongst the most interesting developments in the last 24 to 48 hours. But it's not just that, of course.
No, there's no doubt. And I think the context is very important to understand. But first, editor's cut for everybody joining in for the first time. This is where we look at the headlines and we go beyond it to talk about the analysis. And the gentlemen on my right are the ones that are going to give you that insight. There are two talking points today. One that Niraj just mentioned, and that has to do with State Bank of India, Punjab National Bank, and the action by the Karnataka government. What does it mean in the context of banks struggling to get deposits? And the second has to do with the automotive sector, and we're talking about the implications of a build-up in inventory. Of course, one would say that that is ahead of the festive season, but there's also the implication that the sales demand, or the demand for sales, is not very high at this juncture. But let's start with the banking story, because that really, according to me, is a big story to talk about. Why did this come to pass, and why is it significant?
Okay, so Alex, we need to take a bit of a time travel trip, but 10 years ago, about 10, 12 years ago, 2011, there were some deposits placed by the Karnataka State Industrial Area Development Board with Punjab National Bank, roughly 25 crore in two installments. Yeah. So essentially, this money, a part of this money, about 13 odd crore or 12 odd crore, got involved in some kind of a scam involving the bank's employees. And there was, of course, a police investigation. And then that investigation led to that money being frozen at Punjab National Bank. This is 2011. We are in 2024. That case is still going on, which means that money is not available for the state government to pull out. The other case was with State Bank of India, where essentially about 10 odd crore worth of deposits were used as a collateral for a private sector loan, and the government claims that they did not know that something like this happened.
So that could also have been fraud.
Yeah. So at this point in time, that money is frozen as well. Both the banks have been engaging with the state government for these last 10, 12 years. Nothing has come out of it. The banks have not been able to pay that money because they are legally not allowed to pay that money. That money stays frozen in the banking system. The state government says that, listen, we have waited long enough. We can't wait anymore. What we're going to do is we're going to shut out all business with these two banks, entirely stop transactions, pull out deposits, close our accounts with these two banks entirely.
But that's a hyper reaction to what is ultimately 23 crore.
So you know, one of the reasons why you have the RBI governor coming out and repeatedly telling banks to go after retail deposits, because retail depositors are much stickier than your large-scale depositors like state governments, because state governments just pull out money whenever they want to. This has precedence. This has happened in the banking system back in 2020. That was when Yes Bank was going through severe financial trouble, and then the state governments started pulling out money from other smaller private banks, IndusInd, RBL, Karur Vysya. All these banks had to face deposit outflows because many state governments decided that we don't want to put money here, it's not safe for us, so we'll take our money out and put it somewhere else. Now it's the turn of the public sector banks. Both banks, SBI and PNB, have said that they're going to be having discussions with the state government, try and resolve this issue soon, but we don't know how soon that will be, because September 20 is the deadline for all state government departments to submit a compliance report to the Karnataka state saying that they have done whatever was required in the order.
Some perspective on the size of a state government depositor?
At this stage, we do not know, but typically, you know, state governments, especially a state as large as Karnataka, would have large-scale deposits, a few thousand crores at least. For banks like of the size of PNB and SBI, that the amount is not the main thing, right? The amount is what it is. It's fine. You can, them being large enough banks, they can manage the deposit outflow. Yeah. The problem becomes a challenge to replace that with retail deposits, A.
Yes.
And B, the reputational risk, because both the banks will face a severe reputational risk if a state government decides to shut down their accounts with two of the largest public sector banks in the country. And that's a problem, and that's what they need to. SBI is in the middle of a leadership transition. PNB will get into leadership transition soon because A.K. Goel's term is also ending. So, you know, problems galore for them.
Could there be, and this is the last question from my end, but could there be intervention from the central government? Because ultimately these are owned by the government.
Yeah, but the central government cannot tell the state government what they need to do with their money.
Sure.
Right. At the end of the day, it's the state government's call. It's their funds, and they can decide where to place those funds. If they decide they don't want to do it with these two banks, then that's about it.
Okay, all right. We'll have to see how that pans out. But as Niraj was pointing out, it might be actually positive for a few other banks. We'll have to see what the reaction is in trade. But in the context of banks struggling with deposit growth, this is certainly not going to be an easy pill to swallow for State Bank of India and Punjab National Bank. Let's talk about the automotive sector and let's talk about the inventory levels. Like I was saying, the argument could be made that this is build-up of inventory ahead of the festive season, which starts in September.
Definitely, Alex. Ahead of the festive season, we see about 2 months of inventory that car makers stock with the dealers. So the period is about 60 days. But even in July, on the 1st of July, or even on the 30th of July, we are already looking at higher than that. So as of 31st July, the inventory level was 67 to 72 days. That's actually 12 days higher than what we see during at the start of the festive season. That's around Ganesh Chaturthi in the first week of September, continuing up to all the way up to Diwali, so to speak. So those levels are already being seen. That is the problem that dealers are facing. So at 67 to 72 days, you're looking at about 73,000 crore rupees of inventory. That's about 80,000 cars that are still parked with dealers at this point of time, which is why these alarm bells are being ringing. And why I say that's actually ringing is because of the fact that the wholesales or the dispatches from the factory floor to dealerships have actually declined for the first time this year. Finally, in the month of July, they declined by about 10%, while retail sales actually went up marginally about 2%, because they have started clearing off. So finally, the manufacturers have realized that there is a gap that is present over the months. If you see the numbers, April, May, June, July, so there's a substantial gap between what wholesale growth and whether retail growth. July is the first time it actually has reversed.
That's right.
In the last 2 months, it was actually in favor of wholesale.
But 10+% growth in retail sales in the month of July is quite strong. It's positive.
It's quite strong when you consider that the discounts that are coming in.
Sure.
So in the last few months, people like, say, even Maruti given discounts on the smallest cars.
Sure.
So Maruti that's the breadwinner,
Yeah.
So why would you discount on that? Because they are not no takers.
Okay.
So you have Dream scheme that is coming in. Then you have Mahindra putting on discounts on their best-selling XUV 700.
Correct.
On Tata cars, even there was actually a discount on the Tata Punch as well, about 10,000 rupees in some circles.
Okay.
So yes, so this is happening.
So follow through on that. Ahead of the festive season, you're seeing a little bit of a decline in demand, seemingly. Companies are forced to cut prices. That's going to have implications for margins going forward. So July, September could actually be weaker on the margin front for a few of these automaker. Would you be able to draw that conclusion?
If you say that the production has gone down in July,
sure,
a similar trend should be seen in August and September as well.
Okay.
Because you're still trying to match that gap that
bridge the
gap that is between the retail sales and the wholesales. So yes, in terms of margins, you may see it. But it will again recover in the third quarter, which is the most lucrative for them.
Sure.
So what happens is while by reducing production, remember all the car makers have actually reduced their production finally in the month of July. So the small cars or the hatchbacks reduced by 10%, but utility vehicles are still getting produced.
Last question, is it costly from a financial standpoint for auto companies to keep inventories beyond 60 days on a protracted basis?
For dealers, it is the most expensive.
Sure.
Because you have to maintain.
But it's for dealers, it's not for
the companies. Companies ship the vehicles because of the revenue numbers and the margin numbers, because they also have to maintain this. And shutting down an assembly line is not cost effective,
Yeah.
But dealers have to maintain those costs. So if you park your cars at a stockyard, you have to keep them clean, you have to keep them serviced, you have to basically upkeep, working capital increases, which is what dealers are worried about.
You have a point.
Can I just jump in with one quick question? Do you think that there could be further discounts than what we've already seen? Since we're looking at about 80,000 cars that are parked, we can see more discounts in the small car space. That is the hatchback space. That is your i20s and Balenos, the premium hatchbacks. If the inventory issue spills over into the most largest segment, that's the compact SUVs, that's your Punch, Exter, Nexon, all those, then that becomes a bigger problem because the margins are smaller there, but the volumes are high. But if
they have to discount even there, then we are saying that yes, there's
then
a significant
then the revenue implications become sharper than what they are currently.
And the margin implications. All right, so that's an interesting takeaway. Let's see if that pans out. Of course, we'll have to watch out for the numbers for the month of July as well, or rather August as well, and we'll get some clarity on that. We have to slip into a very quick break. We've got F&O action to talk about on the other side, so do stay tuned.
Hello and welcome. This is India Market Open. I'm Agam Vakil, and this very Friday morning we take stock on the futures and options space and how things can expect to roll out in today's day of trade. Well, we start off with the Nifty. It was a quiet day of trade. It was also the weekly options expiry for the Nifty because yesterday was a holiday and we didn't see too much traction there. A little bit of unwinding as far as the August futures are concerned, which means that a lot of traders did take off their positions. And when it comes to the Bank Nifty, again, let's talk about that with, well, marginal cuts, but it does seem like there was at least some shorts into the system at the moment. Now, when it comes to the options market, we are looking at a new series, and while we do have a considerable amount of open interest written around the 24,200, 24,500 calls, and that could be a little bit of a resistance in the near end. On the lower end, keeping an eye on 24,000, but after that, the next level to keep an eye on, watch out for, is 23,500. We move on and talk about stocks, and it was not an amazing day of trade when it comes to market breadth, because we lost out on Max Financial, Piramal Enterprises, Apollo Hospital, Hero MotoCorp, all of them under pressure, and all of them saw fresh shorts building in. And even among stocks that saw unwinding, well, we had long unwinding for Aarti Industries and GSPL, but that's only because the stocks continued to flow down, and we also had an unwinding as far as its open interest is concerned. The question really is that what do you do with these cues, and well, what sort of stocks that come into your radar as far as the markets are concerned right now? Well, we have Amardev Singh of Angel One who's joining us on the show. Amar, good morning. Thank you so much for joining in. Well, I reckon the first stock on your radar is TCS. Can you tell us why you like TCS? Is it a long or a short, and what's the analysis here?
Yeah, so very good morning. Thank you for having me on the show. So if you look at TCS, we are seeing that the stock did correct from almost 44.50 levels to 41.50. But overall, if you look at the structure of the stock continues to be very strong on the intermediate term trend, long term trend. Also, the stock continues to be very strong. However, on the short term, we did witness some sort of consolidation, and the stock is very close to its crucial support zone. Having said that, if you look at the derivative data, we did witness some sort of short build-up happening in the last session. But overall, I would be positive on the stock. So TCS, one can look at buying a 4,300 call option at around 55 levels with a stop loss of 23 and a target of 94 in the short term. So this is as far as TCS goes.
Okay, so, well, you have a stop loss of 23 and a target of 94. Amar, the other stock on your radar is Axis Bank. Can you take us through that one as well?
Yeah, sure. So Axis Bank is also, if you look at most of the banks, we witnessed some sort of selling pressure, profit booking, be it ICICI, Axis, or for the matter, HDFC. So Axis Bank, if you look at the structure, it's very close to very crucial support zones, and it did manage to find support around the 1130, 1140 zone. If I look at the derivatives data, that clearly shows that there is short build-up, but the put-call ratio is significantly low. So that tells me that there could be a turnaround in the stock from these levels. So Axis Bank is one, because if you look at the August expiry, the PCR is currently around 0.45. So that's an extreme reading. So there's a possibility that we could witness a pullback. So Axis Bank August futures, one can look at buying at around 1150 with a stop loss of 1121 and a target of 1195 in the short term.
Okay, so a call option for TCS and a futures long for Axis Bank. That is what Amar is betting on. Amar, on that note, thanking you for joining us and taking us through your two trading ideas this Friday morning. With that, it's back to you, Samina.
Thank you for that, Agam. We are setting ourselves up for a very solid morning in trade. 188 points on implied Nifty. So that's the kind of excitement that we're expecting to see as we gear up for trade this morning. A start comfortably about 24,300 is what participants will be eyeing. Well, what's leading to so much of euphoria this morning is a very strong handover from Wall Street. US markets were up and about an overnight trade. Asian markets took their cue and are gaining pretty well in early hours of trade. US inflation data that was released on Wednesday late night trade on Wall Street was much better than expected, coming in at a 3-year low. DIIs on Wednesday were net buyers in the market in the cash segment to the tune of 2,236 crores, and large buying from institutions very obviously continues for our trade. So it does look like it's going to be a sharp up move. 24,300 is where we are likely to set stage in today's day of trade. A whole bunch of earnings as well that looked better than what the street was expecting. So even stock-specific action today, the bias clearly is on the positive. But all in all, I think, Niraj, it's looking very, very good. We didn't talk about the DI buying number, but 2,200 odd crores of buying in the cash market. So institutions still very constructive. And we've talked about how they've been sitting on cash, waiting for opportunities that are getting bought into. And hence, any correction that we see in trade is rather shallow and usually bounces back pretty swiftly.
Yeah, I mean, I just take it back to that point, and we'll get our guests to talk about it. But inflation at the rates where it is, since 2021, a rate cut nearly a given, maybe two, maybe a more pronounced rate cut. You're closer to the Fed rate cut cycle. You don't want to risk being caught on the short side.
Or being in cash. So you have to be invested from what most people are saying. And while Niraj and me mentioned it, inflation in the US is at a 3-year low. The good news is that retail sales have gone up and unemployment is coming off. So this is again that Goldilocks scenario that, analysts had been talking about for the US markets about 6 to 7 weeks ago. That chatter had reduced recently with fears of a recession in the US, but for now, all of that seems behind us. But we will get more perspective on how does one trade this market, because if you didn't go home with long positions on Wednesday, you might be feeling a little bit of FOMO this morning, but a good chance that you might get some opportunity to buy in today's day of trade. But before we go into that, lots of stocks that we should be tracking this morning, and they're largely on back of earnings. And like we've said to you, most of the earnings that have come in between Wednesday and today have been better than what the street was expecting. And Varsha is joining us with more on that. Varsha, what's topping your list? Largely good earnings this morning.
Yes, Samina. So thanks for that. Let's start with Glenmark Pharma. Strong set of numbers. They did beat estimates. Revenue growth was led by India business, which grew almost 12% year on year. Now this was due to improved market share in key therapies like cardiac and dermatology, which actually doubled for them. North America business though declined 4.6%, but Europe increased 21.4%. Now they have set key objectives for FY25, where consolidated revenue is at around 13,000 to 14,000 crore that they are aiming for, and when it comes to R&D investment, they are expecting 7 to 7.5% of total sales, and EBITDA margin for FY25 is targeted around 19%, and they are aiming for 700 crores of capex in FY25, and they are targeting double-digit PAT margin. Then we have SpiceJet, weak set of numbers. Lower revenue was led by airline, which decided to reduce the scale of its operation, and the decrease in net profit is attributable to reduction in flight operations due to financial challenges that they're facing. And they're going to raise 3,000 crores through QIP, which needs to be completed by September. Then we have Entero Healthcare, that again strong quarter, good set of numbers, revenue growth of around 22%. Now this outpaced IPM, that is India Pharma market, of around growth by 9%, and they have robust acquisition pipeline. They are targeting 1,000 crores of revenue from inorganic growth, and they are on track with guidance of achieving of around 35 to 40% of revenue growth for FY25, with EBITDA margin expansion over the last year driven by procurement efficiencies, business mix, and operating leverage.
Okay. Interesting numbers there from Entero Healthcare and Glenmark and some of the others. Varsha, thanks so much for putting those into perspective. Chakri Lokpriya, managing partner of Red Strawberry LLP, with us on the fundamentals as well. Chakri, great having you. Thanks so much for joining in. Can I start off, Chakri, by we'll talk about pharma in a moment. Let's just first talk about whether you are a buyer into the markets currently or sitting on the sidelines. We've ended a Q1 which is ho-hum, nothing too great, nothing too bad either. But we are closer to the Fed rate action, right? Would you be invested tactically or otherwise, or would you be sitting on cash?
Good morning. I think if you look at the earnings trend, it's been kind of weak in, autos has been okay. Financials has been very mixed. But autos again have shown weakening sales. So, and if you notice a trend that's been happening is basically people have been buying into the underperformers, FMCGs, Axis Bank, any bank, any company which has underperformed. I don't think that's we are not doing that for the simple reason that we don't see enough absolute returns in those stocks for the, let's say, over the next year or so. But with the Fed rate, down the pike, I think, IT will begin to start doing well. Some of the global sectors would start picking up.
Chakri, that's the call coming in on the index. Let's go quickly and move into stocks. And, Varsha was talking about how good the numbers from Glenmark Pharma were. Operationally, there's an uptake. Their India business is looking good. Profits have jumped ninefold. So even if you just look at the frontline numbers, you'd be more than impressed. Do you feel like there's an opportunity in Glenmark Pharma and it could be part of a strategic portfolio? Because there are a lot of investors and advisors who are constructive on the pharma pack for the next leg of the rally.
Pharma pack, again, we think it's a very similar story of, because people are looking for pockets to invest in. And so we would still be company specific. Glenmark Pharma, in particular, a couple of other companies are doing okay. Their margins are improving both domestic and outside the country. You've seen some amount of traction. And, usually whenever as you head into an election year in the US, the pricing as far as the US generics is concerned they don't mess around with in the couple of months. There is a lot of noise. Against this backdrop, I think, Glenmark, one could buy.
One should buy Glenmark. Anything else in the pharma pack, Chakri, that you would look to buy? I mean, a walk hard as well. Numbers were phenomenal. The stock has been buzzing since it announced that recent drug a few months ago. On walk hard, I know it's expensive, but would you add this on your portfolio for the medium to long term?
Yeah, you said it right. I think it kind of reflects all the good things, and the stock is expensive, so we kind of stay away from it.
Mm-hmm. Okay, stay away from walk hard, but remember the chances of, as Samina was saying, a positive surprise is coming in from that one drug, WCK5222, if I'm not wrong, that's the name, could be interesting. But Chakri's point is well taken. Expensive, they are staying away. Okay, the other piece is stock recommendations for the morning, and we've spoken about some of the newsmakers. Chakri, the earnings season has come to an end. Is there something that has stood out for you, one or two names, that you thought were impressive in their quarterly performance or the guidance or both?
It's quite actually kind of boring to say the same old thing, but some of the PSU names still have shown very good earnings. If you look at PSU banks, the earnings have been better than private banks. You look at some of the industrial companies, their earnings have been better, and industrials in general across, whether it's private or public, have shown good numbers. So consumption has remained weak. FMCG is weak. There's not pickup in broader consumption is kind of weakening. So I think it's more of the same. I think we're still continue to stay with the same old industrials and maybe pick up a little bit of IT, given that US interest rates are going to start. Hopefully, there's an expectation that they'll start cutting them within the next month or so.
Okay. Well, metals are in focus as well. Chinese steel makers have slashed output last month amidst weak demand. In fact, this morning, I hear news that the Chinese central bank has said that, yes, there will be support, but none of the support measures would be drastic. Now, what are the implications for steel makers, for other commodities, and lots more happening in the metal space per se? So, Meghha joins in to dissect all of these factors. Meghha, what's top of your mind?
Yes. So first, let me just start with what the latest China data, said. The Chinese steelmakers have slashed their output in July due to woeful demand. July steel production was 9% down on a month-on-month basis, and this is the lowest figure seen in 2024. Even when you see the first 7 months of 2024, which is Jan to July, the total steel production now stands at 613.72 million tons, which is 2.2% down on a year-on-year basis. And it is to be noted that China produces half of the global steel output. Now, even the top Chinese steelmakers said that the industry is facing a crisis more severe than what was seen in 2008 and 2015. China's real estate market is facing a severe downturn, as well as economic data is reflecting shrinking factory activity. The latest data did show second consecutive month of lower activity. And why China's steel prices are important? Well, the economic downturn as well as the have put pressure on Chinese steel prices. China HRC steel prices are down 3% month on month, 10% year on year, and China is the world's largest largest steel producer, and it often acts like a global benchmark. And it also, the change in prices in China also impact major producing countries like India, Japan, South Korea. And while usually overproduction can lead to price drops and cuts can lead to price hikes, the lower demand scenario has taken an contra effect. And when you look at the prices in India, Indian HRC prices have decreased for the 8th consecutive month as of Tuesday. Prices are down 0.4% week on week and 5% in the last 3 months. And Tuesday's prices were the lowest level in 4 years. So lastly, when you talk about the impact on Indian steel companies, it could be a tough second half. Lower prices impact their profits due to the lower revenue per ton of steel sold. Companies can also face pressure in terms of pricing because they could reduce the selling prices to remain competitive, which also hurts margins. And lastly, they could also see inventory losses if they do hold inventories at a higher cost.
Okay. Mihika, thanks for that. I wonder if there could be a bit of a bounce in some of these metal names or the global facing sectors. Sudeep Shah, Deputy VP, Head of Tech and Derivatives Research at SBI Cap Securities with us on the show as well. Sudeep, good morning. There's NASDAQ has revved up quite meaningfully the last 48 hours. There are some shorts existing in IT and metals, and these are global facing sectors. Do you reckon that an up move today could lead to some short covering in those pockets? Are you watching out for them?
Good morning, Niraj. Niraj, absolutely, you're on the dot, because see, what we've seen, the entire correction that has started into the markets was because of the global, it was led by the global markets. Now we are in the last 48 to 72 hours, we are seeing NASDAQ, then Dow Jones, as well as the Nikkei. These two stock markets were the reason of the entire fall, and they have rebounded meaningfully now. So that is the reason I feel from the lower levels, see, metals, more than metals, I feel IT could do well from here on, and metals are right now under pressure because of the royalty news and everything. So I guess even if there is any short covering into the metal names, it could get sold off into, and we need to see whether the metal stocks say rebound beyond their 20-day exponential moving average, or there some levels below which they have broken down. So I feel more than metals, it could be the IT space that we need to watch out for, and that space would even in fact help Nifty move beyond 24,400 on the upside.
So Sudeep, if that is the world view, if you will, what are the stocks that you're betting on with that view this morning?
See, I have one stock from the IT space, that is HCL Tech. Now, we've seen a lot of these large cap names face correction also in the last 10 to 12 days when the markets were selling off from higher levels. But HCL Tech has almost reversed all its losses of the last 10 days, and now it has given a small consolidation breakout. On the larger time frame charts, if you see on the weekly and the monthly chart, the stock is doing pretty well. It's even outperforming a few of its large cap peers. So I feel from the current levels, HCL Tech can be bought with a 1590 stop loss and a 1680 target on the upside. The second pick I have is from the auto ancillary space, that is a mid cap counter, that is Minda. Now, here we have seen the stock has given a consolidation breakout. It was consolidating in the last 1.5 months between 1070 and 950. And it has even breached its intermediate swing high that was around 1076, 1080 on Wednesday's trading session with volumes. So I guess from here on, Minda could be a stock to watch out for. This can be bought with 1080 stop loss on the downside and 1150, 1170 targets on the upside in the next few weeks.
Okay, point well noted. Chakri, some of the infra names that have come out with numbers today, Capacite Infra, 32% uptick in revenues, margins up, net profit up 180%. KNR Construction, while revenues were flat, margins expanded to 28% versus 22%. Some of these infra names are showing some very strong numbers. Anything stood out for you? And in particular, any views on Capacite or KNR, if you will, because they've just come out over the holiday, if you will?
Yes, infrastructure generally is kind of showing an uptick. The valuations are still fairly, reasonable. If you look at whether it's Nagarjuna, PNC Infra, all these, even KNR Construction, all of them, their margins are kind of improved because of a pickup in industrial activity. Now, going forward, because of this royalty on this mining that the Supreme Court wants to do, the judgment, which I think is a very poor judgment, which will take away some of the growth even from the infrastructure companies like all these various companies. Because, whatever growth was going to come from mining, some of the capex will be deferred. Capital expenditures planned by the metal companies, mining companies will be deferred until, the Supreme Court is cleared. So therefore, the numbers are okay, but, some of the growth expectations will be cut down as a result of some of the Supreme Court ruling.
Sudeep, your view?
Niraj, on Capacite Infra, if you see from the charts perspective, I feel the stock is outperforming in the last few months, where we've seen a lot of other mid-cap stocks witnessing cuts of 20 to 25% in the last couple of weeks. This stock is in a contra trend. It's in an uptrend, higher top, higher bottoms on the weekly charts. So I feel from the current levels also, if someone is holding it from low levels, so the 325 will act as a trailing stop loss, and on the upside 355 to 365 levels could be witnessed here.
Okay. The other bucket is two-wheelers, and post this break we'll of course be hearing out from Ola Electric. But my question is not on Ola currently, my question is on Hero MotoCorp. City's come out with a note. They maintained the buy, but the target price has been cut to 5,800 versus 6,300. Some of the other brokerages too have kind of done the same thing, but they've not sounded as constructive because of blended margins coming under pressure. And of course, losses incurred in the EV side keeps on hurting Hero MotoCorp as well. Defensive name, no longer as cheap as it used to be. Chakri Lokpriya. Would you, if you're betting on two-wheelers, would you bet on ICE? Hero, Bajaj, maybe a TVS, which is a better blend of ICE versus EVs, or would you bet on Ola? But now we have options across the board now.
Ola has run up in the last few days. It was an expensive stock to begin with. It's also already run quite a lot. TVS, if you talk about TVS EVs as a space, TVS Motors has continued to take market share in the EV space. It's continued very well both in its regular ICE business as well as in expanding presence in EV. So that's a name, clearly. Hero Motors, I think the problems are more temporary in nature. Definitely, if one wants to hold for a long enough time, I think one would make money from a Hero MotoCorp. I think the most business momentum is there in a TVS Motor as well as in a Bajaj Auto.
Okay, well, so Chakri prefers the ICE engine companies, not Ola. But if you want to hear from Ola, and we'll take in Sudeep's view on the ICE companies on the other side of the break. But if you want to hear Ola, keep in mind the management speaks to us in just moments from now. Stay tuned. with India Market Open right here on NDTV Profit. ISRO is all set to launch an Earth observation satellite EOS-08 on board the third and final development flight of its small satellite launch vehicle. The Satish Dhawan Space Center spaceport, located about 135 kilometers east of Chennai, is buzzing with activity once again as ISRO gears up for the rocket launch nearly after a gap of about 6 months. The satellite is equipped with 3 main payloads. Now, viewers, this is a big thing. Now we've been used to successes from ISRO and India's space policies and space attempts. So therefore, it doesn't seem new, but it's a big deal. And I'm hoping, as I'm sure all of you are, tremendous success on this one to ISRO and to India. So, yeah, something to watch out for today. Okay, back with markets. About a couple of minute and a half away from the management of Ola talking to us or giving us some sound bites. Sudeep, I want to ask you about Ola. Too short a time frame. The ICE companies, the two-wheeler companies, Hero slipped in trade in Friday's session. Bajaj Auto, TVS. Quick thoughts here.
See, Niraj, Ola is too short a time frame from charting perspective. Yeah. So, but if you see the other stocks, if I see Hero Moto, the divergence was quite visible in the last 6-7 trading sessions, and the weakness was quite evident. But there are a couple of names like TVS Motors also at this level. The stock is showing some strength on the weekly charts, on the daily charts. Dips are being bought. So I feel from a medium-term perspective, 2500 on TVS Motors will act as a strong support, which is closer to the 20-day exponential moving average. And keep in mind that in the last 1.5 month, this 20-day MA has not been breached or on a closing basis even once. So I feel there the strength is there. And also Bajaj Auto, although the speed of the up move has reduced there like it used to be earlier, and the stock is more of a consolidation, it's in a consolidation pattern. But yes, like Hero Moto, we are not seeing any negative momentum here. So at least post this consolidation till 9,500 holds, we could see this 5-figure mark in Bajaj Auto very soon.
Okay. Well, we will watch out for these. Now, remember, so one is the ICE engines, but two is, of course, EVs. And Ola's annual flagship event was headlined by its electric motorbike foray, the rebranding of Ola Cabs to Ola Consumer, as well as a slew of launches. Our colleague Rishabh Bhatnagar spoke to Bhavish Agarwal to dissect the rationale behind these announcements. Listen in.
We announced our first ever listed company earnings yesterday. And the key highlight was that our automotive segment was almost EBITDA positive. You know, we were negative 2% on EBITDA. And that is actually because there was about a 23 odd crore PLI reversal that we had to take in this quarter given the government policy change. Had that not happened, we were actually EBITDA neutral almost. So the automotive segment, many people were questioning earlier, is EVs a sustainable business or not? We, I think, have proven that EVs is a sustainable business. We are EBITDA neutral. And this is not the end. We have a lot of journey ahead to improving gross margins and through operating leverage, improving EBITDA margins. Now let's come to the bike. The bike is built on the same platform as the scooter. So as we bring the bike to scale over the course of the next couple of quarters, it's going to bring more volumes on the same factory, same investments, and hence more margins, more operating leverage. The bikes are going to start with the same gross margin where the scooter is today, not where the scooter was 3 years ago, because the same platform, same supply chain.
In terms of market share, Bhavish, what sort of market share are you seeking in the next year, 2 years, 3 years?
We don't seek market share, Rishabh. We seek consumer love. And we focus on building disruptive products which really capture consumers' imagination. And that's what you see with our bikes here today. We've launched 3 bikes, not one but 3 bikes. The whole Roadster series, Roadster Pro, Roadster and Roadster X, from 75,000 rupees up to 2.5 lakh rupees. For whatever customer segment, whatever price point they like, they can choose their product. So we feel very excited. Electrification in bikes will be quite fast, given the market is already conditioned to EVs compared to 3 years ago. And we hope the consumers adopt our products. And if you look at the marketplace of EVs and motorbikes, actually koi competition hai nahi zyada. So we are the vanguard of this EV frontier in motorbikes.
Interesting thoughts there. Ola Electric has certainly caught the investors' imagination. Not sure about the vanguard moment on the marketplace at least, but the recent spurt since listing for the stock, it has to be recent because it's just listed, but I'm talking about the very recent, like since listing, the stock has had just such a tremendous run. It's not funny. But I must tell you that for every stock, there will be a buyer and a seller. Chakri doesn't quite like Ola. HSBC does. And I'm very inclined to get in Puneet, my colleague, to talk about what is it that HSBC has to say on Ola. Puneet, maybe a quick 20 seconds or 30 seconds on the results as well, if you will. But otherwise, the HSBC note on Ola also very interesting.
Yeah, definitely. Just 3 key points on the results. The gross margin has improved by roughly 870 basis points on a consolidated basis. They've also started reporting the automotive segment as well as the cell segment separately. So we can see that the major margin push is coming from the automotive segment. And going forward, they already have a 49% market share. They are expecting that going forward, they will be, launching a lot more bikes as mentioned in this particular interview as well. Currently, the market is around 1.6 crore by, motorcycles as well as scooters sold in a year. Hero sells 54 lakh out of those. So the point is that if it's going to compete in that 75,000 range, it's definitely going to take market share in the commuter segment. That's what the company is aiming for. It's interesting to see what happens. As you rightly said, HSBC has initiated a coverage on Ola with a target price of 140 rupees per share. It's a 26% upside from the current levels. What they are saying is that they are not very positive on the EV penetration because it's been slower. But the company's foray as well as it's been a flag bearer of EV market going forward with a 49% market share. It also said that it's built its moat around the products that is selling as well as the required parts for this particular scooters and motorbikes is also something that the company is localizing in India, starting with the batteries which will commence from Q1 of FY26. They have said that one key concern is of course for HSBC is seeing the EV penetration and as well as intensifying competition from the like of TVS as well as Bajaj, but they see a positive localization effort being one of the key things that they are positive on. They have a target price of roughly 140, which implies the price to sales of 2.9 times, but this is FY28, so taking in a long time in, and an EV and EBITDA of roughly 39 times. Finally, just 3 things that they see which are positive for Ola specifically. The first is EV manufacturing costs will go lower by 30 to 35%, which will roughly be 30,000 to 40,000 rupees. The second thing is barriers to EVs switching to electric vehicles may fall considerably. There will be focus by states also on this. And finally, Ola's battery venture, which will be a key thing for them to succeed going forward. Battery costs can be lower by 15 to 20 gigawatts per hour. So overall, this is the positivity coming in from HSBC. We'll see what more brokerage views are on Ola as well as the results as well as the motorbike. But this is what we have today for Ola Electric. Back to you.
Okay, Puneet. Thanks for summing it up so well, both the results as well as what HSBC view is. And remember, like we said, that it could go across. Now, enough to spoken about Ola. Let's move on to some of the others. Though I do want to ask an auto question to Chakri Lokpriya. Chakri, the four-wheeler inventory seems to be a cause of concern. And likely, presumably because of just the slowdown that we're seeing. I doubt this is because of the auto inventory piling up ahead of a festive season. In light of that, are you negative on the four-wheeler stocks? Because, for example, M&M has done this launch, right, the Thar launch. The street is very bullish. The target price is substantially higher. Are you constructive on Mahindra & Mahindra and some of the other four-wheeler companies or no?
Four-wheeler companies are still constructive. Maruti still is the market leader. Wilcon, there's no really competition, credible competition. Yes, companies like M&M have. But M&M does lots of things, So from that perspective, yeah, M&M also is okay. Now, in terms of inventories have been building up, they've gone up by a third, so it's not a small number. And that will kind of hopefully be sold in the coming, as we head into the festive season. And a lot of it is dependent on, the sentiment improving, which means there are lots of issues connected around that. So long story short, I think the autos are still not expensive, but I think growth estimates hopefully are not revised down.
Okay. And, this is interesting. Sudeep, on M&M, any thoughts?
Niraj, M&M post that profit booking move that we've seen in the first week of August from 2,900 to almost 2,600. The stock is trying to recover back, and now till the time it is staying above the 2,740, 2,750 mark where the 20-day exponential moving average is there. I think there are chances that we would see some kind of a recovery because this was the best performing stock in the last entire 12-month time period along with Bajaj Auto. If we see the stock has already rallied in the last one and a half year from 1700 to 2900. So post that, I feel it is just the time-wise correction that we are seeing in this stock and nothing beyond that. So this can be held if someone is holding this. 2740, 2730 could act as a trailing stop loss and this could move higher till 2880, 2930.
What are you doing with Glenmark Pharma? They've posted strong earnings, so anticipation is that it should get a gap up this morning. Sudeep, that question was for you.
Okay, yeah. See, Glenmark Pharma, if we see the charts, the weekly charts are ending at a strong move. Last few weeks, it's a substantial uptrend. And today also we have seen 1.5% gap up here. So till the time the stock holds about 1475, 1470 zone where the lows of the previous 3 days are there. Now, I feel the trend would be on the upside. We might see some consolidation, but post that, the trend is still on the upside.
So, beyond Glen, anything else in the pharma pack that you may want to go in from a trading standpoint?
See, it could be it could be a Lupin or so because a lot of other stocks from higher levels we have seen witnessing some profit booking, but Lupin post that rally from 1800 to 2100 is just consolidating closer to its highs. So I feel the daily, weekly and the monthly charts are showing a good structure there. So I feel here there is enough relative strength better than all the other pharma names.
Okay, well, the pre-open rates have settled and we will have a good start, nearly 0.8%. So 191 points, 24334. This is important. Actually, just before I come to Chakri, Sudeep, one quick question. Was fairly high call concentration at 24,150, 24,200. If the markets were to stay higher, do you expect a bout of these unwinding of these positions and could that support the market higher? In effect, my part 2 of my question is, after this 200-point gap up, would you still initiate a trade on the indices?
Yes, see, at the initial part of the discussion, we discussed that the global markets have recovered fair bit and Indian markets have not followed suit. So here I feel that if post the gap up opening of just 180, 190 points, markets sustain about 24,250 spot, 24,230 spot. There could be a gush in the last, say, one and a half hours towards 24,400, 24,450, and then this in effect would lead to this 24,150, 24,200, 250, all these call riders to start covering their positions, and this could further fuel the next leg of the rally. So for me, 24,250, 24,230 zone will act as a key for the first couple of hours just to see whether this gap up sustains or not.
Do you track Hindustan Zinc? There's an OFS that Vedanta is launching today. Stock in pre-open, Niraj just pointed out, is down 7%. Is there any trading opportunity even on the short side?
No, I don't think so. There's any trading opportunity here on the short side because the stock is opening already 7.5% down. So maybe a couple of more percentage points it could still slide because of the quantum, the level of the OFS at the shares at which they are offered. But I will not like to go with any short opportunity here because the risk reward simply is just not in favor.
Okay. You know, some stocks like RHI Magnesita on the back of those numbers are showing an uptick. It's about 3.5% higher, but those numbers were very strong for RHI Magnesita, so watch out for that stock. There is strength in KNR Construction because of their expansion in EBITDA margins, 2.5% higher for that one, 350 today. Swan Energy on the back of very robust numbers that came out on Wednesday is up another 2.5% in the session today. But I must say the quantum of winners and losers, the gains are not very pronounced today. One stock though, and Chakri, want to understand what's happening with life insurance. HDFC Life did really well in the recently released monthly data, and that stock, since that numbers have come out, it's down. I think the last 3 days HDFC Life has corrected quite significantly. Are we missing something? What are you doing with life insurance players, particularly HDFC Life?
Yeah, I think in the case of life insurance companies, and what has happened is, there was some expectation that there will be a price increase. There was a price increase, but that price increase largely accounts for an increase in costs. The medical costs have gone up. The regulations, as usual, have changed to include to include coverage of existing ailments, and so that changes their underwriting policies, underwriting costs. Now, so net of all that, so the price increase was not sufficient enough to provide an acceleration in earnings. So with this scenario, nothing has changed in terms of the outlook is not positive. So therefore, HDFC Life and other insurance companies would not buy.
Deep, we've got 2 minutes to go. You've got a trading strategy on insurance companies and also one stock for the day that you're constructive on, or of course a sell call on.
One stock that I like, despite the insurance companies not being in limelight now, the HDFC Life or ICICI Pru, I feel ICICI Lombard, ICICI GI. Now, this stock is showing good momentum. A 7 to 8 day consolidation breakout we are seeing post this gap up opening today closer to 2000 levels. So I feel overall from a positional perspective, a portfolio perspective, this is a good stock to hold on from the short to medium term time frame. And this could be bought on dips with 1940, 1945 stop loss and 2100, 2150 targets on the upside.
Well, one quick question, Chakri, to you. We've got a minute to go. What are you doing with defense stocks now? Mazgaon Docks had a big order win, very constructive note on Mazgaon Docks. Garden Reach, on the other hand, numbers were good. Bharat Dynamics, numbers were weak. Midani, numbers were weak. So what separates the men from the boys in this pack now?
Yeah, I think because what separates is only the difference in conversion of the order book into revenues. If you look at Hindustan Aeronautics, they missed the numbers, but their order book is intact. So nothing has changed in terms of the long-term outlook of the order book being converted into revenue, which is very strong. So I think that's the story which is largely reflecting, and that was also the reason why Bharat Dynamics actually missed numbers. But, given that defense is such an integral part of the overall story, we would continue to buy Hindustan Aeronautics, buy Bharat Dynamics, and continue to hold on to these stocks.
Sudeep, I'm sorry, but 15 seconds, your top call for the morning.
It would be ICICI Lombard only because this stock I like given the chart pattern here.
Okay, ICICI Lombard from a chart pattern. You are constructive here, right, Sudeep? You're bullish on this
absolutely.
one. Okay, so bullish. Sudeep is bullish on ICICI Lombard from a chart pattern perspective. That is his top call for the morning. We'll revisit that once the rates settle in the first 5 minutes, but let's get the first set of stocks and the markets per se. Strong start, about 0.7% higher, no complaints whatsoever. Bank Nifty participating. I wonder if IT is doing more because there's some shorts in that system, and with Nasdaq and the global markets doing what they do, IT should do well. I won't be surprised if there is more in store in IT today, so watch out for this one. Mid caps and small caps should come up on your screen next. Let's just see if there is some upside there. 0.87% for the mid cap index, the small cap index on your screen about 1%, so not a bad start, must say. Let's get the heat map up on the screen and show you what's moving and what's not. I'll start off with the gainers because there's just a lot of gainers. Hindalco, top of the pile, up about 3%. There is Mahindra and Mahindra up about 2.14%. ONGC about a couple of percentage points. Effectively I can rattle off name after name, all of them in the green except for HDFC Life. Something's gone sour here, but down about 1%. But aside of that, Samina, I mean, well as well hand it over to Samina because almost everything is in the green. I must mark though, HDFC Bank is up in the green, which is a good part because banks were not participating. They've just started to do that. And global commodities. So watch out, 3 IT names or 4 IT names in the list of the top 10 gainers. Samina, that shows you that the globally exposed sectors are the one which are first starting off. Let's see if we build on from here.
We called that this morning, right? IT, metals, that's the space to be in. Banks as well looking good. 49,700 is important on Bank Nifty, so you should track that closely on closing basis. But that is the sort of breadth, right? You've got only 2 companies on the Nifty 50 that are trading lower in trade. That is the sectoral picture. The Wix is down again this morning. And remember, if it gets closer to 15 is when the bulls actually feel a lot more comfortable. Sectorally, there you go. Most sectors are up about 1%. Media, interestingly, gains on good days significantly. Metals and IT are your top 2 gainers. Auto also is holding up, interestingly. So is real estate, oil and gas, and the rest of the market. So it's a broad-based rally that we are seeing. Remember, we are playing catch-up on Wednesday, Thursday, and now Friday. So lots of very strong global cues that the markets are reacting to. But like we said, there's going to be lots of earnings reaction that we are tracking. We'll start with Ola Electric first. This one, because it's top recall, it's hot on the minds of investors and traders. The IPO listed only a week ago. The stock was up 58% as of Wednesday's close. It's at another 12.5%. So back to a 70% gain from listing price. That is Ola Electric for you. The new launch and the earnings seems to have impressed the street. M&M with its launch of Thar is up 2.5%. Another stock to track in early trade. Looking good for M&M as well. In the pharma pack, Glenmark Pharma stood out for us. It was good earnings, largely in line with estimates. But look at the reaction. The stock is actually trading lower. Now, this could be because it's been in line with what the Bloomberg estimates were. But surprising, 3.5% cut on a good day, and pharma may also be on the sell side in today's day of trade, as it's very obviously risk on for the street. Capside Infra posted solid numbers. The stock is up 4%. KNR Construction not too far behind. Good earnings. The stock sees a gain of 2.5%. Polyplex, if I can get that one up too, it should give us a sense of what's happening on that counter. 7%. That's largely on back of how good those earnings have been. Vedanta has extended its OFS in Hindustan Zinc. Hindustan Zinc is down. Vedanta is up 2% higher in trade. Also because metals as a pack are trading quite firm in trade this morning. RH Magnestia, 7.5%. SpiceJet, those numbers didn't look phenomenal. I don't know what the markets are seeing that I didn't catch this morning, but the stock is getting a 2.5% up move in trade. Their finance costs have dropped significantly, and that could be a standout for SpiceJet this quarter. Hindustan Zinc, on back of that OFS, continues to get trashed. Another 7% cut on the counter. SPI and PNB, while banks are doing well and Bank Nifty is holding well, SPI and PNB have ran into some rough weather in Karnataka, but the market's choosing to ignore that, and SPI and PNB actually trading as flat as possible. Niraj, largely broader market earnings reaction is in line with what we expected. I'm only surprised with Glenmark Pharma. Those were strong numbers, largely in line with Bloomberg estimates, which are already running quite high, but the market doesn't seem very happy.
Surprising, because they were very good numbers, must say. But, yep, 3% lower. I wonder if it's a factor of Glenmark having run up quite a bit as well. So that's the other piece, but doing well for itself. First Source is the other one, which is top of the charts, up about 9%. So keep an eye out for that. And UTI AMC, amongst other names, is doing okay today, 3% higher. Keep an eye out for that. Okay. Opening thoughts. Sudeep, I'll come to you first. Opening thoughts, and I'll ask you again. You mentioned that ICICI Lombard is your top idea. Now that the markets have opened and people can buy, would you ask them or would you recommend buying into ICICI Lombard at the current price?
Yes, Niraj. See, ICICI Lombard, it's a medium-term trading recommendation. So it's not from an intraday perspective. So anywhere between this 1970, 1980 mark or 1985, if we get, it's a good entry. 1940, which is the 20-day exponential moving average, the stock has not breached since, I guess, beginning of June. Now that holds as it's a very good support. So 1935, 1940 will act as a strong support. And I feel post some consolidation, we could see the stock head up higher. So the stock is from a medium-term perspective. Now coming to Nifty, slowly and steadily in the first couple of minutes, we are seeing some kind of strength. We are seeing even IT showing a higher strength. Every passing minute, we are seeing IT gaining some strength. So I feel this, if Nifty crosses 24,380, 24,385 mark, we could see 24,450, 24,480 on the upside, which could be a very important mark. Remember, we were discussing in the morning, this call writers running for their money. Now, for that, 24,380, 24,390 has to cross for all these 24, 150, 24, 200 call writers to start covering their positions. And they would like to wait till 9:30, I guess. Generally, all these option writers generally wait till 9:30 just to see whether there is any second round of selling pressure or some giving up of gains from higher side. So I guess 9:30, 9:40 is the time this market sustain about this 380, 390 marks, 24, 390. We could see a good short covering move throughout the day, I guess.
Just a quick check on a couple of other stocks. Midcap IT is looking really good. Firstsource Solution up 9%, Zensar Technologies up 7%, KFin Tech up 4%, Persistent up 4%, Borosil Renewable up 4%, ACT, railway companies all looking very, very good in early trade. So if I look at the Nifty 500 as well, the bias is very clearly on the upside. The biggest loser is Hindustan Zinc, that's down 7%. Max Financial on back of weak earnings is seeing a cut of 3%. Glen Pharma is down. Actually, it's recovered really well. Glen Pharma was down 3.5% when it opened trade. It's down only 1.5%. So it's clearly at its day's high point, charting a recovery in trade as we see it. Varun Beverages down 1.5%. ICICI Pru, Ipca Labs trading slightly quiet this morning. Sudeep, Midcap IT, is there a trade over here?
See, FSL has given a strong breakout now. This stock is up by 9% right now, but I feel even on dips, this stock looks good because the weekly charts are quite strong. Last 4 weeks, we've seen higher bottoms, higher top pattern here. And even post opening, we are not seeing any selling pressure here. The gains are fairly being consolidated. And I feel till 305 level holds, FSL could move higher to 330, 335 levels. And probably more higher because the trend is just getting stronger here.
Point well taken. By the way, just trying to figure out what's happening with some other specific names in trade today. Suzlon is taking it on the chin, so that's one stock to keep in mind. Down in the session yet again. And Bharti Airtel on the back of that upgrade is up about 1%. Chakri Lokpriya, do you like Telecom? Voda, Bharti, do you like them?
I think, yes, clearly there will be some amount of price increases that they would, which is necessary for them anyway to sustain their balance sheet. The competition, of course, all those things are non-existent for the sector. So I think just the volumes will take them through, improve their balance sheets for Vodafone and improve some amount of cash flow for Bharti. So still about a 20% upside in each stock.
Firstsource, Niraj, I don't know if you've looked at it, 10%, and there's no news on the stock. Chakri, is there something you know that we don't?
Firstsource, no, sorry, no.
No. I asked Sudeep about... Sudeep, just specifically on Firstsource, I know we talked about Midcap IT, but very specifically on Firstsource.
Yeah, we just discussed that 303, 305 now holds as a very important support. Until this holds, we could see levels of 335, 340 in the next couple of sessions on FSL. And this looks more stronger across the entire midcap IT space.
Right. Sudeep, Chakri, great talking to both of you. Have a good weekend and we'll see you next week. In the meantime, another stock of the morning is M&M. It's up about 3% the last time I checked. This comes in on heels of Mahindra launching the new Thar ROXX at 5-door version at an introductory price band of 12.99 lakh rupees. My colleague from NDTV, Mugdha Mishra, caught up with the executive director and CEO of auto and farm sector to understand the road ahead for the automaker. Listen in.
This day means a lot to us. We've, over the last 4 years, always done something new on this date. And that's because we associate the brand so much with this sense of freedom. Because, our brand is about helping our customers get away from it all. And, the whole spirit of freedom is actually a part of the brand DNA. And that's why we kind of want to do something different on Independence Day. So thanks, and we really appreciate you being with us here today.
Yeah, so now let's talk about pricing. How did you achieve this pricing? What is the magic formula? Because it looks very attractive on paper.
Yeah, often when we launch products, people wonder whether, we're doing predatory pricing or, we're like underpricing ourselves. But you've seen our auto margins go up with time, and, we've right now reached the business to scale which is fairly large by way of volumes, we do start getting a good volume benefit. We're also amongst the larger buyers of tech in the country at the moment because of XUV700 to begin with, where almost 70-75% of the sales of XUV700 came out of the higher end versions. So in a way, we were amongst the largest buyers of ADAS and a lot of this in India. So many of the suppliers today, seeing our commitment to bringing in or democratizing new technology, have localized technologies for us, and that is helping us carry that into newer and newer products because, in our way of thinking as well, if the more we scale up volumes, the better pricing we get, and then we are able to create greater value for customers.
Because Thar in its original form is a very popular product. But now, first question, how much did you invest in developing Thar ROXX?
We spent around 1,000 crores, which includes everything that went behind product development. It's a completely new platform. And that also includes the money we've spent on the capacity.
And do you suspect that there will be some amount of cannibalization? Because this pricing starts right in the third rear-wheel drive territory and goes up to XUV700 pricing almost. So do you see cannibalization happening there?
We would see cannibalization with the Thar 3-door. We would be happy for customers to make the choices. From our standpoint, the one thing that we've kept in mind while doing the separation between these two sub-segments is not offering the 1.5-litre diesel on this Thar ROXX. So in a way, the entry-level product which we have on the 3-door, often bought by youngsters, college-going people, so on. So we've kept that within the 3-door domain. I also think there'll be customers on the 3-door, who are real off-road enthusiasts, will like the original 3-door look. Of course, this is very compact too, but that's even more compact. But there will be some cannibalization. And in the way we've thought of creating capacity, we built some fungibility in. So we put in a capacity of total capacity right now 9,500 for both the products with some fungibility. So depending on how customers respond between the two products, we'll try and adjust our production.
Good that you mentioned how much production capacity, because that was my next question. But now the question is, your products tend to get a huge response in the beginning, and then they end up having to wait.
In the beginning, but they continue as well.
Yeah, they continue. Well, that's for sure. That's how your excellent market share is showing. But how do you? What's your plan on making sure that there's not too much of waiting period?
Yeah, this is we don't like the idea of waiting period anymore. This was something which was unavoidable in the past because there were shortages and so on. But it's your customers don't like to wait today. There was a time when there were shortages across the board when customers were okay with waiting. But in today's times, customers don't like to wait. So in a way, when we launch this, of course, we'll wait for customers to see the response. Test drive start on the 7th of September and then 14th of September, and then we open bookings around the 3rd of October, and then so we'll wait and see the responses. More customers get to the product. Hopefully there'll be a lot of excitement. Initial excitement has been super over the last 2 days, and phones at our dealerships are buzzing with excitement. It's too early to say what the waiting period will be. Let's see how customers respond at the end of this.
You have built capacity over the last few
company with fairly ambitious capacity expansion plans delivered a quarter which was in line with estimates, but a flattish quarter because the Q1 earnings for NLC India were up about 1.8%. EBITDA was down about 9.4%. Margins cracked about 400 basis points as well. And in some parts with some of the commodity companies, this could be expected simply because quarter on quarter may not really show the entire performance. So therefore, my questioning to Mr. Prasanna Kumar Motupalli, who is the Chairman and Managing Director at NLC India, would be around how does he see the company growing over FY 25, 26, 27 as the case may be, considering that they do have fairly ambitious expansion plans. Mr. Kumar, good having you, Mr. Prasanna Kumar. Thanks for joining in. Some of the quarter, was it in line with what you estimated? Because it's turned out to be a very flat quarter. Could you have done better? And do you expect to do better as the year goes by?
What I see it is that the quarter one is an outstanding quarter for NLC India. There is a all-round improvement in the performance of the company, both in lignite production, coal production and power generation. There is an increase of around 26% increase in the lignite production, 35% increase in the coal production, and more than 10% increase in the generation. And the profit also increased by 37%. So I don't think it's any flat type of performance. It's an excellent performance compared to last financial year.
But yeah, Mr. Kumar, sorry. The reason why I said it's a flat performance is because when I look at the revenue numbers, reported revenue is up 1.8% and reported EBITDA is down 9.4%.
That the reason being, see, although the operational performance, operational income improved a lot, there were some regulatory order because of which the operating margin reduced by 400 basis point, 0.4%. And as we are expecting the improvement in the performance, operating performance going forward, I think an excellent year ahead. The 24-25 and subsequent years.
Okay, so could you tell us what is the kind of improvement that you expect in the operational performance? Because if indeed it was due to one-offs, then I'm sure you will revert to normalcy in quarter two itself. What's the kind of improvement that one can see and why so?
The last financial year, our plant availability factor was around 62%. And that was mainly because of the land acquisition problems we were having. Our lignite production was getting affected. But with support from central government and state government, we could solve the land acquisition problems. That is the reason why since January onwards, we are doing full generation. So compared to last year, 62% plant availability factor, this year, quarter one, it is more than 75%. And plant load factor also against 60% this year, this financial year, it is more than 70%. And as the lignite production and coal production is increasing rapidly, we see better performance in the quarter two and balance part of the current financial year.
Okay. Okay, let me try and ask about the capacities and then we'll come to the longer term plan. So when I look at what your guidance and your capacity expansion plans are, right, on renewable energy capacity from 1431 megawatts to 8,000 megawatts, thermal power capacity nearly more than double, 2.5 times if I'm not wrong, to 10,465, mining capacity to be increased as well, nearly doubled by 2030. When do these capacities start coming on stream? By 2030 is a long way away. So do some of the capacities come on stream in the next 1-2 years? Part one of my question is that, sir. Part two of my question, are you adequately funded for all of these capacity expansion plans?
As you rightly said, although our target is to increase our thermal capacity almost double and renewable capacity almost 7 times, we are targeting to increase it to 10 gigawatt in the recent revalidated corporate plan. The capacity will be added in phase wise. Immediately, we are going to add our Ghatampur thermal power station, which is 3 into 660 megawatts. The first unit of the Ghatampur thermal power station, near Kanpur, that is on the verge of commercial operation declaration. We are going to declare the commercial operation within next 1 month. And subsequently, the Unit 2 also we are targeting for November of this financial year, and Unit 3 in the March of this financial year. So in this current financial year, 2 gigawatt of thermal capacity will be added. In addition to that, our many renewable projects are in pipeline. They will be coming, most of them will be coming in 25-26, but 300 megawatt of our Barsingsar Rajasthan solar power plant, that we will be adding in the current financial year. So in the current financial year itself, we are targeting 2,300 megawatt capacity addition. And in the pipeline, our Talabira thermal power station, 3 into 800 megawatt, the foundation stone was laid by Honorable Prime Minister in the month of February. The activities are in fast progress, and the first unit will be commissioned in the year 2029-30. So similarly, all the solar projects which are in pipeline, almost around 2 gigawatt, the entire capacity will be added by next financial year 25-26.
Okay. So, and I presume you are adequately funded for these. Would you need to raise any equity capital?
Exactly. For increasing the renewable capacity 7 times and increasing the thermal capacity from 4 gigawatt to 12 gigawatt, and increasing the mining capacity from 50 million metric ton to 100 million metric ton, we require capex of 1,25,000 crores. We are going to infuse capex of 1,25,000 crores by 2030. So, and for that, the equity requirement is around 25,000 crores. And we are hopeful to fund it through the internal sources and the asset monetization program, which we are doing for our existing renewables.
Okay, so how much money will come in for the asset monetization program, and when does it, do you see some benefits of that in the current year itself?
No, in the current year, the process is already started. The assets are to be transferred to our fully owned subsidiary. The process is on. We are expecting by March of this financial year or by Q1 of the next financial year.
What's the amount, sir? What's the amount from this asset monetization?
The amount around 8,000 crores.
8,000 crores. Okay. Now, just one final word, Mr. Prasanna Kumar. Your numbers, as I look at them, for the longest time, right? You've been between this 11,000, March 2017, you clocked in sales of 11,000 crores. You've ended the year with 13,000 crores. So you've been in this 11 to 13,000 crore range for the last 6 to 7 years. The capacity expansion plans look very robust. What happens to the top line growth for NLC India in the next 2-3 years? Does it show a meaningful uptick at some year, FY25 or 26 or 27?
See, we are mainly into 3 businesses. One is the thermal power generation, coal lignite production, and third one is the renewables. Out of this, the thermal power generation and coal production both are regulated. So the returns of 14.5 to 15% is assured. And renewable business also, we are taking the projects after doing due diligence to get overall return of around 14 to 15%. So there is a certainty that going forward, the returns will be more than the 15% level because of regulated nature. Out of the total 9,500 crores regulated equity we are having, we are going to increase that regulated equity to 20,000 crores by 2030. So the returns of 14.5 to 15% is assured.
Which is fine, sir. Sorry, just so that I get my point clear. Would your top line go up at any point of time in the next 2, 3, 4 years from this 11,000 to 13,000 crore band?
Certainly, the capacity, our Gatambur thermal power station is getting, the capacity is getting added. So the top line also is expected to increase at a CAGR of around 15 to 16% going forward.
CAGR of 15 to 16%. Okay, with slightly better operational metrics too. No fundraising and good capacities coming on stream. Mr. Kumar, thank you so much, Mr. Prasanna Kumar, for joining in today and giving us your thoughts, and all the best for the quarters ahead.
Thank you. Thanks, sir.
All right, we need to slip into a short break. On the other side of the break, we're joined by Mukund Vasudevan, of SKF India to talk about the Q1 earnings. And also just a quick reminder, on Talking Point today, we speak to ASK Investment Managers Sumit Jain. Back with India Market Open right here on NDTV Profit. Let's keep it with earnings. SKF India reported a quiet set of numbers. Profit rose 3% while margins shrank. We caught up with the Managing Director, Mukund Vasudevan, who spoke to us about their quarter gone by and the road ahead. Listen in.
So thanks, Niraj. Partly right. I'd say I answer the question in three parts. First, I think we took some conscious calls this quarter on the top line to prune customers who are not that profitable or product lines which are not profitable. So that brought down, especially in the wind and some in the railway segments, which brought down our top line growth, but increased our profit a bit. But that was offset by the profit was offset by increase in traded products where the costs have actually gone up. Traded products being other manufacturing plants of SKF globally, where we're importing from, and the cost of those have gone up, which has dropped our margin. But if you look at a long-term trajectory, nothing changes. We have consistently over the last 4 years delivered 12% plus CAGR of top-line growth, 17%, almost 17% of PBT growth CAGR. Our quarter doesn't change our trajectory. Quarter doesn't change our strategy.
Got it. So, okay, just trying to understand this. When we're talking about you consciously taking a decision to prune down on customers which are not profitable. So therefore, you are effectively telling me two things here. That one, there is enough business opportunity, even if you prune down customers, to clock in that 12-15%, whatever the number of growth that you have in mind. over a long term in FY25 itself, never mind the one quarter miss, and that margins which went down this quarter because of the higher traded products, you will eventually have the ability to take it higher, because I'm guessing you've pulled down the lower margin customers. Effectively, your margin should inch higher.
Right. So, Niraj, you're exactly right. So, this is a blip in this quarter. We will see uptake in it on both the top line and the bottom line in subsequent quarters. Just to give you an example, this quarter also, we have seen in the heavy industry, the metals industry, which are infrastructure driven, we've seen almost 25% plus growth in our business. So there are pockets of growth here. There are pockets of high profitable growth, and even things like wind and railways. While this quarter was slow, but we will see profitable growth in the next few quarters.
Got it. So, Mr. Vasudevan, you taking over at a time when there is a new 5-year term, lot of emphasis on capex, infrastructure, the budgets around railways, etc., don't seem to have changed too much. Maybe no announcements per se, but it seems that those sectors continue to gain move along the path charted for them over the last few years as well. How do you see your divvying up your resources and your production and your manufacturing between the newer opportunities versus themes that have been continuing? Because like you said, you're making some changes. So we are unaware of what industry contributed to the low margin thing, what industry contributed to the higher margin thing.
Yeah. No, I think we'll make some changes. Some of the traditional industries are still big for us, big in the sense, around 10% contribution overall. They will continue. But if you take within automotive, EVs is still very small. But obviously, we have to put more resources against that to develop products which suit that market. We also have to build our sales team in that, but we won't do it disproportionate to where we see the growth and contribution of that in the future. Some of our traditional, even within automotive, two-wheeler and four-wheeler markets or commercial vehicle markets are important, that we have to protect our base and continue to grow there. Same in the infrastructure areas, right? We will continue to focus on that, but there'll be emerging things coming. In the next 5 years, India may see semiconductor plants. We have, SKF has some excellent products for those. High-speed machinery, right, coming up as manufacturing increases. Those are all emerging markets, and we will continue to invest in it. But in terms of full shift, it will not happen.
Okay. But so therefore, let's assume that by virtue of the brand name and the product suite that you have on offer with the technology on the products that you may have, you might be the port of first call. Let's assume that. And if we work with that assumption, my question to you therefore is that even if the 5-year trajectory you stick between 10, 12, 14, whatever that number might be, CAGR, will you be able to do it at better operational metrics? Because Q4, for example, due to favorable pricing, your margins really got a bit of a bump up. They've come off a little bit, but is the longer term trajectory higher on operational metrics?
So I'd say, we'll sustain and continue to grow the margin, and the margin will be driven by many things. One is increased localization. We have increased even in from last year to this year. We're seeing almost a 10% more of localized products being sold into the market, which will improve our margin fundamentally. We will also see, while it will make us more competitive, but it will also improve our margin. We will also do this, continuously look at what we spoke about in terms of pruning and saying, how do we manage our portfolio to make sure we are focused on the most more profitable customers. Manufacturing, one of our strengths, that is a continuous improvement exercise. It is about making many small improvements continuously so that our costs of manufacturing come down. So those are all actions which we continue to take.
Got it. I would love, just moving away from SKF for a bit, but not entirely, I would love to understand from you, where do you see, or which industries do you see the best demand sound bites from currently? Because there was an election quarter, there is a new government, there are some changes that might be there in priorities, who knows. I'm trying to understand what is sounding business as usual or BAU, and where is it that you believe, or where is it that you are sensing higher demand from?
I would say 4 sectors, and this is probably more traditional. The metals, mining, and cement, driven largely by the infrastructure spending that will continue. I would say that is one area. The second would be in terms of growth. I'm not talking about volume. EVs, both in two-wheelers and four-wheelers, we will continue to see some growth. And then renewables. I think railways is kind of lumpy, but we'll continue to watch out. Within railways, high-speed trains like the Vande Bharat or Train 18 are areas of our fortes for SKF, and we will continue to kind of gain market share there, continue to invest in new technology development.
Got it. So industrials and light vehicles, of course, helped you in Q4 as well, and you believe those two continue to be the areas where the demand might be strong?
I would say so, yeah.
Got it. Okay. Sorry, moving from margins to revenue to back to margins or supply chain issues a bit, if I can. Maybe not margins really, but a lot of companies that we spoke to mentioned about higher shipping costs and slight disruption in the supplies because of what's happening in the Middle East. Is that something that impacted you as well by any chance in the quarter, or is that something that might impact, if you will?
So we did have higher impact of it, right? I would say less so on margin. It's small. There is some contribution. Luckily, we are manufacturing almost 60+% locally, so only 40% is imported. So, but that 40%, I'd say the impact has been more on availability than on margin. So if anything, it has been delayed deliveries of a product rather than on the margin itself.
Okay, and I believe you and the parent body, the parent company, I believe you've made it known enough number of times that there is a high focus on India, focus on R&D spends as well. I would love to understand from you for SKF India, localization and made in India, something that you referred to, some blueprint of that. And is there a sense that, because a lot of other MNC peers of yours tell me this, that they are sensing a higher sourcing from made in India products for the rest of the world by their global parents. I'm trying to, it may or may not be in your case, but I'm just trying to understand.
No, it is true, right? I think there's, first of all, I think it's a perfect storm for India. I think with increasing geopolitical tension, the China +1 coming up, and the increasing awareness and recognition for India's manufacturing strength, there's clearly a drive to set up more manufacturing here. Interest from customers to say, can you make it in India and send it to us, whether it's in Europe or in America. But let's not also ignore the Southeast Asia, Australia market, where again there is a significant amount of opportunity for us to export. From SKF India perspective, we continue on that path of localization. My philosophy on this is kind of let's localize to make sure that we win in the local market. If we win in the local market, we will be competitive in the global value chains also. So we will get natural pull from other countries to be able to sell to them. As far as the parent is concerned, there is it's a competitive value chain in the sense if America's finds the most competitive place to manufacture a product and believes India is the most competitive place, they will buy from there. That's the philosophy we follow. And so we sell to our other entities also, the parent company entities. I would say that is something which we will continue to do and continue to strive to be the best competitive manufacturer.
Yeah, most certainly and completely understandable as well. One final word, what are the risks to this growth numbers that you've alluded to? Because, you being conservative, you've in the past as a company, in the last 4-5 years or maybe before that, at times under-promised and over-delivered, which is a great thing. I'm guessing that you are being conservative or cautiously optimistic right now as well. But what's the risk to even that?
I would say, it's the standard things, right? There's obviously geopolitical risks, right? I would say, various things like even elections in the US could move things one way or the other in terms of our export, right? I'm really glad that with the stability of the government and the continued focus on some of the areas they're focusing on is continuing, right? So I would say from an operational perspective within India, I don't see much risk. I would say it's much more of a geopolitical risk. Now, if America or some of European countries go into recession, then it could change the game because investment flow into India would decrease. And that could change kind of our investment in new capacity also, the pace of investment in new capacity also.
Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat with our guest today, a guest who oversees nearly 35,000 crores worth of equity AUM and therefore has a worldview which very few people might have on the equity side. Let's bring up the case for a chat. We try and, of course, ask him about how the mood on equities as we inch closer to the rate cut cycle, if you will, and whether earnings can sustain the valuation premium. Will autofocus remain in FY25, or will we see that high decibel sector come off the wheels a little bit? And will global facing sectors like metals, like IT, see further pain, or could the scenes improve post the Fed rate cut? Sumit Jain, Deputy CIO, ASK Investment Managers, with us in the show. Sumit, great having you. Thanks for taking the time out. I hope all is well.
Very much. Thank you, Niraj, for having me here.
Yeah, no, pleasure is entirely ours. So, Sumit, as we inch closer to a potential Fed rate cut cycle, and presumably other central banks follow suit, I was looking at the markets since the COVID lows. The biggest driver, unequivocally, independent of valuations or markets, has been the central bank. Correct. Would this time be different, or do you reckon that despite the higher valuations, an rate easing cycle can spur equities further?
See, at the end of the day, equities are function of growth. They are also function of what is the volatility of that growth, and then how long can we see this growth kind of continuing. Each markets will behave differently. We may see some markets undergoing some pain, because at the current point in time what we are saying is not necessarily about markets, but geopolitics also is playing a significantly bigger role. So I really believe what we would see is some markets doing in a particular manner, other markets actually may behave very differently. India actually stands at a point where I really believe growth rates can continue for a significantly longer period of time. And if you look at volatility of India versus other parts of the world, that is dramatically different. In the past, in case of any volatility, we would have seen our currency actually going tailspin. This time actually has been different, right? So what India presents today is combination of growth and lower volatility. This lower volatility actually feeds into lower or rather relatively lesser volatility in currency and also relatively lesser volatility, or I would say focus on cost of capital. Right? So if your volatility is low, cost of capital actually may remain subdued. And add to that, if you were to think about cost of capital also going down globally, markets actually may continue to remain buoyant. Right? So what we need actually to focus on is, are our earnings growth on track? Quarter after quarter, while quarter may be a shorter time frame, we need to look at relatively longer time frame. In the short term, things may be volatile for reasons. But if those are on track, if we can see sustainability, then I would actually not be worried in markets.
Okay, and I'll come to the earnings in just a moment, but just tactically, just to make viewers understand why I was asking that question that I did, around budget and maybe post that, a lot of fund managers, mutual funds, and maybe even certain PMSs were sitting on large dollops of cash. Our analysis suggested that the mutual fund industry alone was sitting on over 1 or 1.2 lakh crores of cash. Now, my question, why I'm bringing this tactical perspective here is that assuming that some of that cash has gotten deployed, but not all, would a rate easing cycle force some of the capital sitting on the sidelines to get deployed globally into global risk assets, locally into Indian equities as well? And can that spur the market higher? I'm asking you for a tactical view. I know you don't necessarily take that, but just think about it.
No, so see, this time rate easing actually could be a function of lower growth rates globally.
Sure.
Right? And if you look at US markets from a very short-term perspective as well, it remains very confused. So if you look at markets yesterday itself, when retail sales were pretty decent and rate cut expectations were pushed forward, yet we saw markets actually going up and going up decently. Right? So markets actually from a rate perspective will matter, but not as much. It is about, are we seeing growth coming by, right? And that is where I would say India is different. Right?
Okay.
And over period, I would think this cash deployment will happen in India. Many of the managers may be looking at more shorter term because are we saying markets are cheap in India? Not necessarily. Markets may be valuing dollar for a dollar possibly. Right? So to that extent, only when we deliver onto those expectations, we would kind of make decent returns.
Okay, fair call. In which case, let me ask you, since you mentioned that markets would be quote unquote slave to earnings as the case may be, what did you make of the Q1 season? It was expected to be not so buoyant a quarter. I thought it kind of turned out to be that way. The sell side notes are saying that too. What did you make of the quarter and the commentary thereof? Do you believe that earnings are in fine fettle or not quite?
So it was a very interesting quarter actually.
Okay.
Because if you look at the quarter gone by, there were multiple factors which were one-off. Heat waves were pretty intense in the country. We had elections, right, which actually impacted businesses, right, from a short-term perspective. But even after that, if you were to dissect the quarter gone by and look at how sector after sector they have performed, possibly one can make a guess that commodity-related businesses actually were impacted significantly more than other part of the market. So when I say commodity, I mean global commodities. You can look at cement as well. You can look at oil and gas businesses as well. X of that, earnings growth actually have not been that low. It has still grown upwards of 15%. So to that extent, businesses which are relatively more structural, relatively where India is focused on, actually are in fine fettle. We may possibly say order inflow for capital goods infra businesses may not have been that great, but that was expected as well because this was election season. Some amount of tendering actually gets delayed. Right? So irrespective of this shorter term phenomena, do I expect year as a whole we kind of deliver 14-15% earnings growth? I would think that is the kind of run rate that's possible. In fact, not only for a year, possibly for 2 or 3 years is something that's a very high possibility.
Oh, okay. So therefore, this 20-21 times forward earnings multiple that we are assigning to markets, or the Nifty, let's not say markets, it's a very bottom of market currently. But if I use Nifty as a benchmark, is 20-21 times earnings 1 year forward a reasonable valuation to pay then?
At an aggregate level, possibly, yes. But, you know, when we look at indices, they hide many things, right? So to that extent, it will have a host of businesses, right? Businesses which will which fundamentally have lower PE, businesses which fundamentally have significantly higher PE. But difference versus past in case of India is this valuation improvement is backed by superior margins and superior capital efficiency as well, right? Our ROEs of the past and ROEs of today are different. Balance sheet of many of the stakeholders, whether you talk about banks, whether you talk about government, whether you talk about even consumers for that matter, corporates, actually is way better as compared to what it was in the past. Right? So to that extent, looking at valuation from the past lens actually may not be an appropriate thing.
Fair call. But yeah, because you ought to admit that the ROE profile of Indian companies and you know, a lot of people talk about 21 times being so expensive, viewers, but look at that. These numbers are not an anomaly. I mean, Indian markets now have gradually elevated themselves to those multiples. So it's not that we are trading at a 21 multiple, whereas in the past we used to trade at 15 times. So in some sense, I think it's a point to reckon with. Sumit, I would love to talk about some of the pockets, because you mentioned that an index hides more quite a bit as well, and therefore it's very idiosyncratic about specific pockets. The largest weightage in our portfolios, right, and for the market portfolio, which is BFSI and banks. What's the sense there? I mean, I hear equal and opposite views on private banks, for example, from fairly smart people. I'm trying to understand what is the bull and the bear case argument, and where is it that your bias stays?
So see, the way we look at it is, from a growth perspective, I'm not worried. Will our credit growth be closer to about 13 to 15% over a long period of time? That's a very high possibility, right? But it's not only about credit growth. It is also a function of how do we fund that kind of credit growth, right? Deposit is a challenge. Regulatory interventions are relatively higher. That has impact on cost of doing business as well, right? It has implication on the inherent growth that bank can deliver with the kind of ROE that they have, right? I believe many of those steps may be right steps from the regulator perspective, but it does have implication on what kind of ROE can bank deliver, right? So we, in general, have a relatively lower weight in banks as compared to, in fact, significantly lower weight in banks as compared to what it is for the markets.
Okay. So what, within financials, are you constructive anywhere? Lending, non-lending financials?
I believe NBFCs are relatively better placed. Even many of these non-lending businesses, right? Whether it is market infrastructure linked businesses or other lending, non-lending opportunities. Even for example, savings opportunity is a large opportunity in the country, right?
By savings you mean wealth or AMCs?
That is right.
Okay.
Right?
Okay.
So, you know, these are businesses which are significantly smaller as compared to the opportunity that presents to all of us, right? Over next 5 years, 10 years. If I ignore the shorter term, possibly many of these businesses will be significantly larger, right? So we actually are relatively more focused there.
Okay. I'd just love to probe this a little bit more. On capital markets, and I'm choosing that one, and then I'll probably even try insurance a little bit. But first, capital markets. AMCs, some regulatory actions done in the past brought down the ability to earn the margins that they used to, if you will, now has stabilized. AUM is growing, the opportunity size is large. Is that a good pocket? Part two of my question is wealth. Non-AMCs necessarily, not just asset managers, but doing other kinds of market functions as well. There are, various opportunities out there. And then I heard you use the term market infrastructure. There are 3 or 4 players now there too.
That is right.
What within this bucket?
No, so if you look at depository parties, DPs, or if you look at registrars, right? So we have quite a large opportunity in that area. In fact, it's not only players like CAMS, KFINs of the world, but we have exchanges as well, right? Wherein, if you look at commodity exchange today, volumes are significantly lesser. Over period, they will be significantly larger, right? So it's not only about AMCs or wealth, but the basket is significantly larger in non-lending spaces.
Non-lending space. Okay. Just a word on insurance. I mean, the sector, has always shown this argument of India being an underpenetrated market. But I was doing the math since listing for some of the private insurers or even for LIC, the the stock price return and maybe even the earnings growth has not been commensurate to the promise at least that it held, right? Correct. It's been, for lack of a better word, a fairly sluggish return that these guys have given relative to some of the others, financial or even the non-financial buckets. Now, I as an investor, I'm not compelled to buy into an insurance name. I don't need to have it in the portfolio. What is your view here? Are you constructive insurance? If so, why? If you're not constructive insurance, why not?
So I think opportunity clearly is large, whether we talk about life insurance or non-life, right? If you look at non-life insurance, general insurance businesses as well, over last 15 years, industry itself has compounded at between 13 to 15%. If one were to take into account all the general insurances that are there, some were not there in the past. Crop insurance has come in later, right? So that has actually accelerated the overall growth for the industry. Having said that, those businesses which actually can deliver a decent ROEV, or for that matter ROE, actually they will be value creators, right? So that is something we'll have to keep monitoring.
Okay, fair call. Sumit, stay on. We need to slip into a break. On the other side of the break, viewers, we'll talk about consumption in slight more detail, because that's the other interesting piece in the run-up to the festive season, and the fact that that space has gone through its own set of challenges in the last 12 months, particularly the lower end of the K curve. So we'll talk about that. We'll also try and talk a little bit about industrials. The results have been solid. The management commentary is bullish, but the valuations too are fairly steep. So try and talk about both of those very wide buckets with Sumit Jain. Stay tuned. Back with Talking Point in conversation with Sumit Jain of ASK Investment Managers, and we were talking about financials in the first segment and the markets at large. Now, talk about consumption. That's the big thing. Now, Sumit, a lot of varying views. We were at the MK conference for the last 3 days when the conference was on. A clear-cut winner was the revival of the rural consumption. Yeah. The commentary, maybe even in terms of evidence from the companies and their numbers. How do you think about this piece? I'm going to break up consumption into a few. Sure. Start off with the rural-focused themes. And is there a change in sentiment and performance that you believe in, that you may have seen in results or in your conversations?
So, see, let's go to the past first. For last few years, that space has actually been impacted. Multiple factors have led to the impact on this space. Rainfall has been erratic. If you look at inflation, that has also had a very large bearing on their income levels. Right? What I believe from now on is, if you look at government stance as well, focus on job creation, focus on skill development actually has increased pretty dramatically. We may possibly start to see revenue expenditure of the government also kind of starting to inch up a bit versus what it was in the past. Last few years, revenue expenditure actually has been very subdued. So I really believe we may be possibly at a point where rural actually starts to bottom out. If you look at numbers as well of many of the corporates, the volume growth of even FMCG businesses actually has stabilized at lows. Over period will start to gain in terms of volumes, right? Will they be better than what they were in the past last 2-3 years? They should be better. Will they be significantly higher? Because many of these staple businesses from the penetration perspective are pretty decently penetrated. Can we expect them to grow at a significantly faster pace? Not really. But will they normalize? I really believe we will actually see normalization in many of these staple businesses. In fact, not only it's about staples, but I really believe many of the rural businesses with respect to agriculture, they actually will start to see improvement.
So on staples, just stabilization of the business, does it revert them back to the erstwhile higher multiples? They anyways traded high multiples.
They traded similar multiple as compared to, close to similar multiple as compared.
So
but the difference versus the past is, in the past, their margins were on an improving trend.
Right.
Today, their margins are closer to what they kind of, they are not very different from the peak, right? And they will have to invest into advertisements as well. So to that extent, will we see profit growth way higher than revenue growth? Not necessarily.
So then, therefore, you will not, I'm presuming you will not have a large bet on them, if you will.
On the consumption side, what I would think is the place to be in would be discretionary.
Right? Okay.
If one were to ignore, let's move on from pure rural to the entire consumption basket, right? So, if you think about IT spend as well, or rather IT hiring as well, we have seen actually IT hiring going down for last 5-6 quarters. Now this quarter has been a mixed trend. Some companies have hired, some companies still continue to remain at a number which is slightly lower, but that rate of decline actually has come down pretty meaningfully. So I really believe it's not only going to be about rural, but also about urban. Both parts actually should start to do well. What does this mean? Some of the discretionary kind of businesses, small ticket discretionary, could be consumer durables as well. Their improvement is going to be pretty sharp. That is the area I think is what one should focus on.
Okay, so could you elaborate, because it's a very wide bucket. You've given us a very succinctly, but still, how do you think about this, and therefore what pockets come to mind?
See, I think discretionary is a very, very interesting area. Consumer durable is just one. Then building products would be another. You would see many of those retail-oriented businesses, right? Smaller ticket, right? Which actually are used in household consumption. Those actually also will start to do much better. And many of these businesses have actually created niche for themselves. Right?
Okay.
They have created distribution network. Over last few years, they have focused on the distribution network. And when we start to see normalization, their rate of growth actually accelerates.
Oh, okay. So, and within this very wide bucket, is there a first amongst equals? Are you more constructive on some specific buckets within this wide consumption? It could be building materials, it could be something else, it could be air cooling solutions, what have you?
You already started to see improvement on the consumer durable side. Everybody knows that air conditioner sales have been pretty solid, obviously. Climatic conditions have helped. But it's not only about air conditioners. If we look at refrigerator sales as well, if we look at washing machine sales as well, they used to be pretty low. Last quarter has actually been some improvement, right? So we are already seeing some improvement on that part of the market.
Okay, fair call. So you do expect that that improvement might continue, and therefore that's a discretionary consumption bucket that you might want to bet on.
That is right.
It's a very small. The other part is very small, which is the upper end of the K curve, Sumit, which is the premium luxury spend market. Maybe 3 or 4 players present. They've had a really good run until now. Can it kind of moderate, or do you believe that continues?
I see no reason for that not to continue. In fact, what I see is significant change in consumption trends as well.
Okay.
So earlier it was largely about, one can say, product consumptions. Today services are also turning out to be a decent part of their consumption expenditure, right? So if one thinks about tourism as well, right? It can be part of the K-shaped recovery as well, right? The way you see numbers of many of these hotel industries, right? While Q1 may not have been that great, but clearly the commentary is different as compared to what their numbers were. So when we look at tourism, it's the entire ecosystem. Your hospitality businesses does well, your travel tourism does well, your travel agencies does well, right? So it is the entire ecosystem which actually starts to see improvement. So it's I would say multiple pieces, as you rightly said. Some on the product side, some on the experience side.
Okay, and therefore that brings me to my next question. I'm really keen to know, how do you think about aviation as a bucket? It's a small bucket. Let's say 4 or 5 listed players out there from airlines and airport operators milake, right? It's a sector that traditionally has never made money. But we've seen in the last 4 or 5 years, one airline come out and show that it can make money year after year after year. Airport operators seem to be doing okay as well. And the space is still evolving. Is that a long-term play, or is it difficult to take a call?
See, airports clearly will make money over a long period, right? But do we have enough listed players on the airport side? Pretty few. Even on the airline side, we just have very few listed players, right? Having said that, we will see more number of airports getting listed over a period. Not sure of will we see more number of airlines getting listed or not, right? Having said that, see, on the airlines, clearly world is short of aircrafts.
Right.
The ability of both the large aircraft manufacturer to kind of deliver aircrafts on time is challenged. So those players which have solid balance sheet will stand a better chance to actually increase their fleet sizes.
Right.
They stand a better chance to supply. Right? Demand should continue till the time prices don't go out of whack. Right. So will there be some level of elasticity? There will be, right? And we'll have to see where this equilibrium lies. But will we see airline traffic increasing at a rapid pace? We'll certainly see that. And will that be catered by few players? It will be catered by few players. Right? So will profit pool keep going up? If one were to ignore the volatility of external varieties that one can see. For example, crude plays an important role for these companies, right? So if crude is under check, currency is under check, we should see a decent profit compounding from these businesses.
A large profit pool, very few people can take advantage of. So key point to note. Just rounding off that conversation, and I'm presuming that you're constructive on hotels and some of the others as well selectively. I have one final question, Sumit, and which is now moving tracks and sectors, because you mentioned about IT services hiring, etc., and stuff like that. Because we are looking at a cut cycle, so on and so forth. What about external facing sectors, be it IT services, be it metals, etc.? Is there a tactical play, because some of them have been stagnant or been beaten down in the recent past?
Can there be tactical play? Possibly, yes. But we don't want to get into tactical plays per se. Simply because many of these businesses possibly may see relatively lower growth, while their growth rates may accelerate from the past of very low single digit kind of number to possibly high single digit. That is what one may possibly look at. Over long period, can we anticipate many of these businesses to grow at a relatively faster pace? I have my own doubts. Does India offer better opportunity as compared to many of these external global plays? Certainly, yes. There are many Indian, I would say domestic oriented businesses which actually over next 5 years, 7 years, 10 years will grow at a rate much faster than what we are talking about, right?
On the technology side, you're saying?
Not necessarily on technology side, but possibly on domestic, domestic consumption, or on the industrial side, right? So to that extent, I would think there are a lot better opportunities as compared to pure software services that are there. Within software services, what we would actually be more focused on is into those businesses which actually are very focused on few areas, have strength. Technology investment there are increasing at a very rapid pace. It could be R&D investments there or ER&D investments there, which are increasing at a rapid pace. And consequently, they may be beneficiary of the large trend that the world is witnessing.
Okay, so maybe ER&D or maybe product companies which could be doing this. Great. Okay. Sumit, so good talking to you. Thank you so much for taking the time out and being with us. Really appreciate it.
Thank you, Niraj. Thanks for having me here.
The pleasure was ours. And viewers, thanks for tuning into this edition of The Talking Point.
Benchmark indices fall from opening highs. The Nifty trades below 24,300 while the Sensex trades at 79,500 range. All sectoral indices, well, trading the green, barring pharma. Ola Electric continued its rally as the company forays into electric motorcycle segment with the Roadster series, while M&M trades 2% higher after launching a new 5-door Thar Roxx. Meanwhile, Hindustan Zinc dropped to its lowest level in 3 months as Vedanta will sell a 3% stake in the company. ISRO successfully launches Earth observation satellite from the Satish Dhawan Space Center in Andhra Pradesh. This mission follows the second successful launch of the second test flight in February. Hello and welcome. This is the F&O show. I am Agam Vakil, and in this show we take you through all that is happening in the futures and options space in Indian equity markets, and it's been turning out to be a reasonably steady Friday. Now, while we haven't seen the strength that your global markets have shown, but well, we do have green on the key indices. The Nifty up around 0.3%, as is the case for the Bank Nifty as well. And all in all, when it comes to the key contributors for the Nifty, well, it does seem like a little bit of a reversal of sorts as well. But remember that for now, it is largely names like TCS and Infosys which are providing the bulk of the gains in terms of contribution, and the gains are not substantial. We have a 100 odd point advance against a 32 odd point decline. That's also where we're not seeing too much weakness come through. HDFC Life perhaps to a certain extent contributing to that. This is your advance decline ratio, and well, we have nearly 2 gainers for 1 loser on the NSE at the moment. And it's certainly not a bad decline, certainly not bad market breadth, at the moment. But let's also take a look at the futures and options space and see how things are faring there. So when it comes to the Nifty futures, and that's where we are seeing continuing to see unwinding coming through. Open interest declined by around 1.4%, even as the underlying advances, and it's holding on, it seems, for now, to the mark of 24,400. The Bank Nifty as well, which is in focus today, is also advancing by around 0.3%. That's where the spot is. And as far as the change in open interest is concerned, it's negligible at the moment. Coming down to the options market, earlier on in the session, we were telling you about the kind of writing that we've seen around 22,400, 22,500 thereabout. And 22,500 calls specifically, it does seem like it's going to be a near-term resistance, because we have seen the Nifty come off from that mark this morning as well, and you never know. But I reckon that perhaps we will have to wait for the next week to give us more clarity on whether or not we can, in fact, see the Nifty make a dash back towards the mark of 25,000. For now, that doesn't seem to be the case, and with the kind of call writing that we've seen on higher levels. And of course, on the lower end, we will continue to see a little bit more of or should I say support around the 24,000 mark. We haven't seen as much traction when it comes to writing of those puts, 24,000 and thereabout. And well, that's another thing to keep an eye on. It does seem like the markets are a little bit more, in fact, assigning a slightly higher probability of either staying where they are or perhaps moving down based on the options activity at the moment, as what we're seeing. Let's also take a look at the Bank Nifty options and see how things are faring there as well. And, as far as the Bank Nifty is concerned, at least in terms of the kind of levels that we are watching out for, we are, again, keeping an eye on, we're keeping an eye on 50,000, and sure, we're currently trading, at least the spot is currently trading, or rather the futures currently trading slightly higher than that, and the spot is also in and around there. But 50,500 is perhaps that 500 point upper bound that we're going to keep an eye on as we move into trade this upcoming week. But on that note, let's get in our experts. We have Akshay P. Bhagwat of GM Financial and Aditya Arora of Analytic.in, who's joining us on the show. Good morning to both of you. Thanks you so much for joining in. Akshay, start with your assessment on the Nifty 50 specifically. Are at around 24,200 now. And we are still seeing the Nifty remain range bound. What levels are you keeping an eye on, and how are you trading this index?
Good morning, Agam. So yes, it's been around 8 trading sessions where Nifty is still in the price range of 24,400 on the upside and 24,000 at the lower end. Sooner or later, it's time that this trading range gives way. And if you look at the positive side of this entire range, it's the India VIX, which is showing signs of a cool off at 15.5 odd level. So that's somewhere indicating that a support is in place. But the only problem here in trading this range is that majority of the gains or losses come in form of gaps. So that's causing a bit of a pain point for the trading community. I would say that if positions have not been taken as yet, the best time to take a position is wait for levels of 24,450 to be overcome. Yes, it's a time consuming level, but till for stability to get back, prices should also support 24,450 is the level which should surpass. Then only there will be a strong short covering bout from the call sellers who are strongly placed at 24,500. If not, then there is again a good chance that Nifty can aim for levels of 23,900 on the downside, which would be a good risk reward payoff from the buy side. So clearly a no trading zone for the Nifty index as it stands right now. If you are a day trader, then for the day, there is a chance that Nifty might drift to the lower end levels till 24,150 or 24,100, because for the day, the sentiment and the price trading action is a bit on the weak side.
Of course, it's also come up from the day's highs at the moment. Aditya, good morning to you as well. How are you trading the Nifty 50 at the moment?
Very good morning to you and very good morning to everyone. So we are basically staying light on the index because domestically we have seen a lot of short position in index future in last 5 days in derivative space, and a lot of call writing and put buying in derivative space. So that is creating pressure on the downside, as Akshay rightly mentioned. And internationally, we are seeing very good global cues. So this is creating a market which is, full of uncertainty and no clear-cut direction. Hence, we are staying light on the market, and we are waiting for a breakout above 24,500 on index future, which could, give a proper breakout and could lead to short covering. So that would be the time, when one could, think of going long. Otherwise, right now, we actually don't have a clear-cut direction technically. Hence, we are not taking any position.
So no position on the Nifty 50 at least. But Aditya, anything on the Bank Nifty then?
Same is true for Bank Nifty. We have seen short position in Bank Nifty also domestically in derivative space. So once Bank Nifty breaks 50,500, that would be the time to think about building long positions in the market.
All right, Akshay, how are you reading the Bank Nifty at the moment?
Yes, 49,500, that's an important support zone, a possible double bottom under formation. Still, the confirmation is not clear, but yes, there is demand at the levels of 49,500 to 800. So if anyone is really keen on taking a buy trade, then the stop loss should be strictly below 49,500. We are at the support zone and trying to bounce. So if it recovers from here, 51,000 is the upside in Bank Nifty. So yes, no trades for today, at least for day traders, but positionally, if one is keen, keep a strict stop loss, because Bank Nifty can be the dark horse bet here. If there is a recovery, then Bank Nifty can recover hard. That's the thought process I hold.
All right. So, those are the levels that you can keep an eye on as far as the benchmarks are concerned. We'll also try and get an idea on what's happening from the stock futures front. So if we can actually pull that list up and see where there is in fact traction there, and could give us a better inkling of there. So we have longs in something like an Emphasis, which is advancing by around 5%. That's where the spot is, and good traction as far as longs are concerned. TCS also is actually seeing longs coming through along with HCL Technologies, and MCX continuing to climb, this time, pardon me, around 3.5%. Max Financial is under pressure. That's down nearly 5% as well, but it's seeing a 6.5% increase in open interest towards what looks like fresh short. So that's something to keep in mind as well. What about stocks which are seeing unwinding? Let's see where there is in fact a decline in open interest. If you disregard Vodafone Idea, because there's something wrong with that particular number out there, we have Piramal Enterprises, which is actually looking at a bout of short covering. Remember, Piramal Enterprises was down 10% on Wednesday, and now it has advanced. It's certainly a case of short covering coming through. Grasim and JK Cement also looking at, some amount of short covering. But what about stocks on the radar of our experts? Akshay, stocks that are looking interesting to you?
Yeah. So from the current levels, there are two stocks which I have identified from a short to medium term basis. The first one is DLF. If you look at the price structure, it's been confined in the range on broader price charts. And today there's been a good opening and a good follow through momentum in the first hour of trade. So I'm looking at DLF for a possible target of 897 to 910 with a stop loss of 822. The second trade here would be Tata Motors. This too has seen a very strong support base being created at the levels of 1,000. And lately, last couple of days, there has been good long additions in the futures and options segment. Today also is a good start, which the stock has registered, looking at targets of 1140 to 1167 with a stop loss of 1054. So DLF and Tata Motors would be the two top bets to deal in the current market situation.
Okay. Aditya, what about you? Stocks on your radar this morning?
So me and Akshay are on the same page when it comes to DLF. So one of my recommendation is DLF only. Over here, one can go long on 850 call, which is trading at 17.75, and one can short 870 call at 10. Maximum profit potential is 10,106. And maximum loss potential is 6394. So that is stock recommendation number one for me. And second one would be Dixon. This stock is trending since a while, and the outperformance is continuing today. So one can go long on 1230 call at 296.20. And one can sell 12,500 call at 215. Maximum profit potential over here is 11,880. And maximum loss potential is 8120.
All right. Well, those are some trading ideas from our experts. So on that note, I'm going to maybe take just one or two more stocks before we can actually conclude this conversation. And among a handful of these names, which are actually buzzing in trade from the futures and options space, well, we do have advances on quite a bit of them. Tata Motors is one such mover as far as your futures and options space is concerned. It's been a perplexing, move when it comes to Tata Motors, and of course, it's been a relatively volatile counter and a lot more volatile as compared to a lot of its larger peers, which is why perhaps it's also a trader favorite. But it's after making a low of somewhere around 1,000 rupees per share about 8 to 9 sessions ago, it does seem like Tata Motors is starting to advance once again. But the question is that can this slight up move be bought into? Let me take this up with Akshay. Akshay, what's your assessment on Tata Motors at the moment?
So Tata Motors is one of my picks which I've recommended today. And if you look at the price structure, first of all, on the weekly charts, it had registered a very powerful breakout 3 weeks back at the levels of 1,000, 1,030. And that's the reason, there is good buying at those levels of 1,000, 1,050. 1050 lately when there was a small correction in Tata Motors. There are a lot of long additions in that particular range, and the price structure also is noting demand at every dips in the stock. So very strong price structure in the entire auto pack, and one of the best names to be positioned in the current choppy market conditions. A recovery and supported by the markets can easily see the stock again heading for the swing high of 1160 plus. So be positioned on the buy side, look for buying opportunities at the current rate. Stop loss would be 1030 on all your buy positions from a short-term perspective.
Okay, there you have it. I guess that's all the time that we have on the show. So taking a moment to thank both our experts for joining us and taking us through their views in the markets, and of course giving us a handful of trading ideas to work around with. Time for a short break, but we will speak to the management of Mazagon Dock on the other side of this break. Stay tuned in and we'll be back in just a bit. Welcome back. We are now in conversation with Mr. Sanjeev Singhal. He's the Chairman and Managing Director at Mazagon Dock Shipbuilders. Mr. Singhal, good morning. Thank you so much for taking the time out. It seems like it's yet another very good quarter, given that this particular quarter also has seasonal weakness. It does seem like you guys have come up with good growth. Of course, the margins have been stupendous, but I'd reckon that this is also on account of the change in the order profile that you all have seen over the course of the last 1 year, and naturally profitability has more than doubled over the course on a year-on-year basis. Mr. Singhal, just wanted a better idea of going ahead. How can things pan out when it comes to your top line and the bottom line for the balance of this financial year?
I would not be assigning any numbers with respect to the top line, but yes, at the same time, considering the momentum at which we are executing the projects right now, I definitely expect that over 22-23 there should be a decent growth. A better clarity would be visible to us also during Q3. As far as deliveries are concerned, during this financial year, we are eyeing for 3 deliveries. One destroyer, which is the last destroyer of Project 15 Bravo. The first frigate of Project 17 Alpha, and the last Scorpion submarine, that is the 6th submarine of the Project 75. Apart from this, if things go well and as per plan, then maybe we can look for a second delivery of the frigate also during the financial year. So that would be a record performance by itself. However, the second frigate remains a bit touch and go kind of a situation. It could be the end of this financial year or early next financial year. As far as the bottom line is concerned, yes, going ahead also, we see reasonably good margins, whatever we have been posting, because the deliveries are happening as per the schedule or prior to the schedule. As a matter of fact, in case we are able to deliver the last destroyer by October also, this would be almost around 5 months before schedule. And any delivery before schedule has a significantly positive impact on the margins.
Right. Mr. Singhal, just want to understand that once you do have these deliveries which have come through, revenue recognition is that already at peak? Or do you think that the most amount of revenue recognition happens on delivery?
No, revenue recognition is by and large smooth. So it is not that it happens at the time of delivery. But at the same time, considering that we have 3 parallel projects going on and we plan to close 2 of them, that is 15 Bravo and Project 75. As far as the deliveries are concerned during this financial year, so it is quite possible that 25 may be the peak revenue. However, we are also looking at other segments. Recently, last year December, we received one order from ONGC with respect to undersea pipeline laying. Continuing ahead, we have recently received another order of 4,600 crores from ONGC. This is also offshore and undersea pipeline laying. So this is also one revenue stream which we are adding as a diversification. We were in the offshore business around 22 years back, but in between we had practically abandoned it. So we are reviving this segment of our business also. And moving ahead, we definitely believe that with respect to the 3 additional submarines, Scorpion submarines, the things are maturing and better visibility is there. So we expect this order sometime soon. And for 75I, which is 6 number of submarines with AIP fitted and lithium-ion batteries, there we are participating along with TKMS Germany. And the field evaluation trials with respect to the combined bid of TKMS Germany and MDL has been successful. So moving ahead, we are positive about this order also. Apart from the 17 Bravo frigates, which is under discussion at nascent stage, and next generation destroyers in the shipbuilding area. So these would be 2 major orders, which maybe with some time lag, they should be materializing, and MDL definitely remains a very strong contender for them. And with respect, another order, that is next generation corvettes, we are likely to submit the price bid by next week. So this also is an order where MDL will be competing. So I see a strong order pipeline, not only in the area of shipbuilding, submarine, and as well as offshores.
Sure. So I actually want to get a better idea on when it comes to your stealth frigates. So from what I understand, please correct me if I'm wrong, the current order book has about 4 P-17 Alpha stealth frigates which are under, under construction right now. And besides that, you also made a mention of new generation frigates, which will also be a part of execution going forward. So can you give us an idea about your overall current order book and also what we can expect going forward when it comes to the frigate segment specifically?
Yeah, as far as the order book is concerned, as on 30th of June, it stands at 36,800 odd crores. And as of today, it is roughly 40,400 odd crores, considering that we have recently received an order of 4,600 crores from ONGC. Moving ahead, as far as the frigates are concerned, 17 Alpha, we are currently executing 4 number of frigates, of which the first frigate we are likely to deliver by third quarter of this financial year. And continuing in the same series, there is 17 Bravo. We expect there is a requirement of around 7 or 8 frigates, new generation frigates, for which we expect that at least 4 frigates would be on MDL. But this would be taking a bit of a time before the things firm up. So, but before my execution for the 17 Alpha is complete, we are positive with respect to the new generation frigates order also.
Just a very quick question. So, what is the usual timing on the execution of a single frigate?
These are telescopic designs, so normally it should take anything between 5 to 7 years, depending upon the design maturity. Considering that 17 Bravo, we don't expect very major changes in case it's a continuation of 17 Alpha. The timelines could be reasonably decent, between 5 to 6 years for the first, and subsequently the gap would be around 6 months to 12 months for each additional frigate.
All right. Okay, so we leave it at that. Thank you so much for joining us and taking us through the latest with respect to Mazagon Dock. Of course, this has been one of the biggest movers as far as the last 12 months is concerned in terms of share price, and it continues to trade near life highs at the moment. It has continued to see strength of late, but that's the management of Mazagon Dock. But with that, we've also reached the end of this show, so it's a wrap on this edition of the FNO show, but lots more lined up on the other side. Keep watching NDTV Profit.
and welcome to NDTV Profit. You're tuned into the small and mid-cap show. My name is Rucha Sumaya. We'll begin with a small market check. Talking about Nifty 50, indices have recovered from the day's low. The index is up about 100 points. Well, talking about the constituents which are in the green, largely the insurance players. We have HDFC Life and SBI Life. Actually, these are the stocks which are contributing negatively to the index, down about 2% each. But in the green, we also have IT players like Wipro, LTI Mindtree and TCS contributing positively to the Nifty 50 index. But with that, let's move on to the Nifty IT index, and this index is up about 700 points. And when we look at the constituents of the Nifty IT index, we largely have the mid-cap names such as LTTS, Emphasis, which are up about 5% in the trade today. Moving on to talk about the Nifty Bank Index. Again, this one has also recovered from the day's low. The index is up about 130 points. But when we look at now the index is up about 200 points. Well, great recovery over here. But when we look at the constituents, we have SBI, which is largely flat. However, PNB is trading in the red. Now, this comes after the Karnataka government has asked all the state institutions to close their bank account in these two names. But SBI not reacting that much to the information that we got in the morning. But let's talk about the mid-cap 150 index. Now, this one is also faring well in the trade today. The mid-cap 150 index is up positively, up about 175 points. So decent performance over here. And again, when we look at the constituents, we have Emphasis, LTTS, again the mid-cap IT names in focus. So IT is something which is doing really well in trade today. But moving on to the constituents in the red, we have Hindustan Zinc. Now, the company has set the price for its offer for sale at 486 rupees, which is 10% below the current market price. As we can see, Hindustan Zinc is down about 6% in trade today. So this is what we had on the market check. But let's talk about the IT name. In fact, a mid-cap IT name, eClerx, which reported its results yesterday. Well, eClerx is also faring well in trade today, up about 1.5%. Well, the numbers were pretty decent. Revenue was above estimates, while margins and profits were below estimates. But to talk to us more about this, let's get in Mr. Srinivas Nadadur, the CFO of eClerx Services. Welcome to the show, sir. Thanks for taking out the time. What is your first take on the results that came out yesterday?
So we are pretty pleased with how Q1 has turned out for us. So revenue, as you mentioned, came in decently. Margins were down. However, this is not unusual for Q1 in any quarter because we just paid out our wage hikes. And that's a major component of the margin drop. We've also invested in hiring business development leaders in our client geographies. And that's the other major contributor to the reduction in margin. So overall, we are fairly pleased with the results. And we think there is significant growth potential given what we see of the deals that we have signed in the quarter, plus what we see of the pipeline that we have.
Right. As I can see, the margins actually took a hit, which came in at about 17% versus 21% in the last quarter. So you also attributed this to the wage hikes and senior management hires that you made out in the current quarter. So how do you expect the margins to fare in the coming quarter? Do you see